To order without objection, the chair is authorized to declare a recess of the committee at any time. Today we meet to hear from the director of the FHFA, no stranger to this committee, our former colleague and truly our friend Mel Watt, who the Senate confirmed to his current position in December of 2013. A special welcome to the director. Most of us know him well. He was the representative of North Carolina's 12th District for 21 years. And I can say from both sides of the aisle, he is one who served on this committee with both honor and distinction. It was a pleasure to serve with Mel, and I always listened very carefully when he spoke. I rarely agreed with anything that he said, but he always commanded my respect, and I listened carefully because, again, he was a thoughtful member of this committee. I certainly admire the fact that the director has chosen to continue his career in public service. I might remind my friend and colleague that when he was on this side of the witness table, he's always demanded of the witnesses short, concise, and substantive answers. So I have no doubt, now that he is on the other side of the witness table, that he will continue to demand the exact same from that side of the witness table. And once this hearing is over, I can't wait to ask my last question is, Mr. Director, which did you enjoy more, being the inquisitor or the inquisitee? Although I suspect I already know the answer to that question. And now, before we get started with opening statements, I wish to yield a brief moment to the ranking member for a special welcome as well.
Thank you very much, Mr. Chairman. I, too, would like to welcome Director Mel Watt to this hearing today. I must admit I was somewhat torn when Mr. Watt received this appointment. While I know and always knew that he would do a great job at FHFA, I knew I was going to miss him on this committee, not only because he was such a thoughtful, well-prepared member of the committee. I could count on him as the one person who had read every line of a bill. Mel Watt not only had read every line of a bill, he was the one that could come up with the question that no one else could come up with because he had spent so much time reading the bill. I also appreciate the fact that he served an important role, even when Barney Frank was the chair of this committee. When there was a need for tough negotiations, Barney Frank turned to Mel Watt and would ask him to work with the opposite side of the aisle to work out the differences. And he did that on any number of occasions. Barney Frank could never trust me with that. And I understand why, and everybody else understands why. But Mel Watt certainly did serve in that role for all of us. So we're so pleased, again, that you're over at FHFA, and we think that despite the fact I mourn your not being here with us on this committee, we know that you're the right person for that position. And we're very pleased that you were able to hit the ground running because you knew and you know the issues so well. So welcome, Mel Watt. We look forward to hearing from you today. And don't worry, if anybody on the opposite sides of the aisle tries anything with you, I'll take them on, okay? Thank you.
You're going to be busy. The purpose, again, of today's hearing is to take a testimony from the director of the FHFA to learn about the conservatorship of the GSEs. I now recognize myself for 3 minutes for an opening statement. As Yogi Berra once famously said, it is deja vu all over again. Memories are clearly short among Washington's ruling class because they are repeating the same mistakes that caused the 2008 financial crisis in the first place. Contrary to the fable told by the left, the root cause of the financial crisis was not deregulation, but dumb regulation. Regulations and statutes that either incented or mandated financial institutions to loan money to people to buy homes they ultimately could not afford to keep. Exhibit 1, Fannie and Freddie's affordable housing goals. 70% of all troubled mortgages were backstopped by Fannie, Freddie, and other federal agencies. And contrary to the fable of the left, it ultimately wasn't Wall Street greed that brought down the system. Of course there's greed on Wall Street. When hasn't there been? But there's also something known as Washington greed, greed for power to command and control huge swaths of our economy. Greed to have Washington allocate credit within our society as opposed to we, the people, in a free and competitive, transparent, and innovative market. The mentality of this Washington greed is best summed up by Obama architect Jonathan Gruber, who famously stated, "The American people are too stupid to know the difference." I doubt the American people collectively would have been foolish enough to roll the dice on taxpayer-backed subprime lending. Clearly, Washington was. The dice were rolled, millions lost their homes, the economy was brought to its knees, and hard-working taxpayers had to pay for the mother of all bailouts. Regrettably, Washington appears to be rolling the dice yet again. Within the last 12 months, FHFA has announced 3 different policies that are harmful to transitioning us to a sustainable housing finance system that protects both homeowners and taxpayers. First, by suspending a previously scheduled increase to fees Fannie and Freddie charge for their loan guarantees, FHFA is leveraging the taxpayer balance sheet, one that is clearly awash in red ink, to lock in a near government monopoly. Next, in a race to the bottom with FHA to become the nation's largest subprime lender, FHFA has announced that it will begin to allow the GSEs to buy mortgages with as little as 3% down. As history repeats itself, historically prudent underwriting standards are yet again being thrown out the window. The data is overwhelming that there is a direct correlation between delinquencies and foreclosures on the one hand and low down payments on the other. Finally, and most recently, FHFA has announced it will begin siphoning off taxpayer funds from Fannie and Freddie in order to begin filling government housing slush funds. All the while, Fannie and Freddie remain ridiculously leveraged and continue to threaten hard-working American taxpayers. The best affordable housing program is a healthy economy, not a doubling down on failed Obamaeconomics, and certainly not more risky housing schemes from Washington. It's time to grow our economy from Main Street up, not from Washington down. It is time to get off the boom-bust bailout cycle. It's time hardworking middle-income families have greater economic opportunity to achieve financial independence and the opportunity to buy a home they can actually afford to keep. I now recognize the ranking member for 3 minutes.
Thank you, Mr. Chairman. Again, let me welcome my friend and our former colleague back, Mel Watt. Director Watt, in the years since you became head of the Federal Housing Finance Agency, you have taken important steps to ensure that our housing market remains affordable and works for everyone. With Fannie Mae and Freddie Mac now having paid the government $225 billion, which is $38 billion more than the Treasury invested during the crisis, I think it's fair to say that our actions to prevent a total collapse of our housing market have been a resounding success. If we close the GSEs without putting in place a viable alternative, as my Republican colleagues would do, we would likely re-enter a recession. In fact, I think it's our economy's best interest that the PATH Act lost what little momentum it may have ever had. And Director Watt, your actions to demonstrate that you are fulfilling your statutory mandate to preserve a liquid, competitive, and national housing market. Similarly, the FHFA has finally abided by another statutory mandate to fund the Affordable Housing Trust Fund. This one action will help improve, especially in districts like mine, the availability and affordability of rental housing. There are 7.1 million American households for whom safe and decent housing is neither affordable nor available, a situation made worse due to Republican attacks on public housing and voucher programs. But by complying with your statutory obligation to allocate a tiny percentage of Fannie Mae and Freddie Mac's profits to these funds, we have the chance to improve the lives of millions of American children, families, people with disabilities, and the elderly. I also applaud your efforts to expand the availability of home ownership for all Americans, including Americans who are qualified borrowers but are not fortunate to come from wealthy families. When FHFA lowered the down payment requirements, it appropriately balanced safeguards to protect the taxpayer with expanding credit for eligible borrowers. Moving forward, I encourage FHFA to think outside the box when it comes to credit scores to ensure that all credit-worthy borrowers have a chance at the American dream. So I thank you, Director Watt. And again, we welcome your testimony today, and I yield back the balance of my time.
Chair now recognizes the gentleman from New Jersey, the chair of our Capital Markets GSE Subcommittee, Mr. Garrett, for 2 minutes.
Yes, thank you, Mr. Chairman, for convening today's very important hearing. Thank you, Director Watt, also for being here and your testimony as well. And I would like to begin today's hearing by commending Chairman Hensarling for your work and your steadfast commitment to reforming our nation's broken housing finance system. Our housing finance system, and more specifically the GSEs, were at the heart and center of the recent financial crisis. And while I realize the odds are long and the political issues to overcome are immense, I do believe that reforming this broken marketplace must remain a priority of this committee in the 114th Congress. So I'm heartened at the level of substantive engagement by members on both sides of the aisle with a number of specific legislative proposals introduced by the chairman, the ranking member, and Mr. Delaney as well. These proposals and the bipartisan bills in the Senate provide a foundation from which to continue negotiations with Congress and hopefully reach bipartisan consensus on a reform package. Now, Director Watt, you've been quoted as saying that you believe that GS reform should be left up to Congress and the FHA should not interfere. And while I appreciate the appropriate deference you pay to the body where you once served, it is important to understand that no matter your intent, any decisions that you make as director will impact upon reform efforts, either positively or negatively. There's no way for you to avoid that. So given that, I would hope that your decisions then would err on the side of helping to facilitate reform and not acting as an impediment to it. So lowering down payments, preventing risk-based guarantee pricing, and the funding of the Housing Trust Fund, those things will make it harder to reform these entities and quite possibly lead us down the path of another multi-billion-dollar taxpayer bailout. These decisions bring to mind the old saying, those that don't learn from history are doomed to repeat it. So subpar underwriting standards, taxpayer-subsidized pricing, encouraging people to buy homes that they simply can't afford, well, they were the main causes of the last crisis. So I'd ask the Director, please don't let these decisions lead to the next one. With that, I yield back.
Finally, the chair now recognizes the gentlelady from New York, the ranking member of the Capital Markets and GSE Subcommittee, Ms. Maloney, for 2 minutes.
I thank the chairman and ranking member for calling this important meeting, and it's a pleasure to welcome our former friend and our former colleague and good friend Mel Watt. You are missed on this committee. Director Watt has been on the job for 386 days, and he has proven to be a thoughtful, deliberative, and conscientious leader of this tremendously important agency. He has focused on maintaining the liquidity of the mortgage markets and on increasing access to credit for credit-worthy borrowers. For example, his first act as director of FHFA was to delay a planned increase in Fannie and Freddie's guarantee fees, which would have raised the G fees even more in states with stronger consumer protections, such as the one I represent. This was never a sound basis. There was never a sound basis for penalizing states that have strong consumer protections in foreclosure. and I applaud Director Watt for this decision. States that have strong consumer protections should be rewarded, not penalized. In addition, he halted the arbitrary 10% cuts to Fannie and Freddie's multifamily businesses and created an exception for small and affordable multifamily housing. This is hugely important for my district, where multifamily housing is our single family business. He has also allowed Fannie and Freddie to buy certain mortgages with a 3% down payment, which will allow borrowers with strong credit histories but not stockpiles of extra cash to get a mortgage. I think that decision is tremendously important, and he was guided by the data, which clearly demonstrates that the size of the down payment is not the most important factor in predicting default rates. Finally, he recently made the decision to start funding the National Housing Trust Fund and the Capital Magnet Fund, which will provide hundreds of millions of dollars for affordable housing programs. This was a critically important decision because this is one of the only dedicated sources of funding for affordable housing that we have. Thank you very much. We're delighted to have you back here before the committee.
Gentlelady yields back. Director Watt, welcome once again to that side of the witness table, and you are now recognized for your opening statement.
Chairman Henseling, Ranking Member Waters, and members of the committee, thank you for inviting me to discuss the work we are doing at the Federal Housing Finance Agency and for providing my first opportunity to return to this committee since I left Congress. This actually might be the first time since I left that I have the sense that I might be better off on that side of the table. FHFA is mandated by statute to ensure the safety and soundness of the federal home loan banks, Fannie Mae and Freddie Mac, and to ensure that they provide liquidity in the national housing finance market. FHFA works to balance these obligations across all of our activities. Because Fannie Mae and Freddie Mac are also in conservatorship, we are also mandated by statute to preserve and conserve their assets. Earlier this month, FHFA issued a new scorecard that outlines our conservatorship expectations for the enterprises in 2015. FHFA's conservatorship strategic plan that we issued in 2014 and the scorecards we issued in 2014 and 2015 are centered around three strategic goals that are fully aligned with FHFA's statutory mandates. The first goal is to maintain the credit availability and foreclosure prevention activities supported by the enterprises, and to do so in a safe and sound way. During 2014, in support of this goal, FHFA made considerable progress with the enterprises to clarify their representation and warranty framework, to encourage responsible lending to credit-worthy borrowers, and to enhance the enterprises' outreach and provision of service to small and rural lenders. In 2015, the enterprises will continue their work on these and other priorities, such as analyzing the potential benefits and feasibility of using updated or alternative credit score models. The second goal is to reduce taxpayer risk. The primary way we do this is by increasing the role of private capital in the mortgage market. In 2014, FHFA tripled the enterprise's credit risk transfer requirement, and the enterprises executed transfers on single-family mortgages with a combined unpaid principal balance of over $300 billion last year. In 2015, the enterprises will continue to use the models that have already proven successful to transfer credit risk, and they will explore other ways of transferring and reducing risk to taxpayers. Our third goal is to build a new securitization infrastructure for use by the enterprises and adaptable for use in the future mortgage market, whatever that might be. Last year, we defined the governance structure of the Common Securitization Platform, and the enterprises announced a CEO for this joint venture. We also made significant progress toward our multi-year goal of developing common securitization platform technology and a single security. Our strategic plan and the 2015 scorecard also have affordable rental housing priorities for the enterprises. The focus here is not to compete where there is adequate private sector coverage of the multifamily market, but to ensure that affordable housing is available and that the housing needs of people in rural and other underserved areas are met, including areas that rely heavily on manufactured housing. FHFA is also focused on regulating the Federal Home Loan Banks. As part of our responsibility to ensure that the banks fulfill their statutory mission and support housing finance in a safe and sound manner, we proposed a rule last year concerning the bank's membership requirements. Our comment period ended earlier in January, and we received approximately 1,300 comments. I want to emphasize that getting and evaluating input from stakeholders is a crucial part of our policy-making process. We will carefully consider comments made by members of this committee and the public in determining our final rule on the bank membership standards. We are also actively considering input we have received on guarantee fees, single security, and the enterprise housing goals. I've covered a lot more areas and provided a lot more details in my written statement, and I look forward to responding to your questions. Again, thank you for the opportunity to testify. I'm happy to be back, especially since I know that I'm free to leave after the hearing is over.
The chair now yields himself 5 minutes for questions. Again, thank you, Director Watt. I wish to echo the comments of the chair of the Capital Markets GSE Subcommittee. I fear, Director Watt, that you have reversed policies of your predecessor, which will make it more difficult to have a sustainable housing finance system. I want to first focus on what you have done when authorizing the GSEs to backstop 3% down loans. You have previously testified before the Senate, quote, "We know that the size of a down payment by itself is not the most reliable indicator of whether a borrower will repay a loan. All things being equal," because I've looked, I cannot find your thoughts on the subject, but all things being equal, is a 3% down loan riskier to the taxpayer than a 10% down loan?
I would say, Mr. Chairman, that is generally true, but when you pair the down payment with other compensating factors, which is part of the sentence that apparently people missed when I announced this, you can make a 3% down payment loan as secure.
I understand there are other factors. Okay, I understand there are other factors, Mr. Director, but also ability to repay. Surely it's an indication of whether or not a home buyer can save if they can only afford 3% down. Do you believe that 3% down is riskier to the home purchaser than 10% down?
Again, the same considerations would apply to the borrower as would apply to the lender. If you carefully look at other considerations and take them into account in deciding whether to extend that credit, or in Fannie and Freddie's case, whether to back that credit, then you can ensure that a 3% loan is just as safe as a 10% down payment loan.
Well, let's explore some information that has come out of your agency previously. Can I have the chart from the Federal Register, please? Your agency, frankly, along with Treasury, the Fed, FDIC, SEC, and HUD, I know like most charts, it is somewhat difficult to read, but on the horizontal axis, this is loan to value ratio. On the vertical axis is default rate. And to the far right-hand corner, you see a precipitous rise in default rates when you go from 90% loan to value, and particularly an incredible slope from 95% as we reach no down payment whatsoever. Again, this is information that's coming from your agency along with just about every other prudential banking and housing regulator. So doesn't that seem to indicate that, again, a 3% down payment, not only is it not too good for the taxpayer, you're once again putting people into homes that they can't afford to keep. And you have previously testified when you were on this side of the witness table during the Dodd-Frank proceedings, quote, so I've always believed that you cannot make a loan to somebody who cannot afford to repay it. That's unsustainable. This is data from your agency and others. So why is it sustainable?
Mr. Chairman, I haven't changed my position on that, and I want to assure this committee that I have not changed my position. You should never make a loan to somebody that you cannot anticipate would pay it. But if you couple
well, this again, this is data. This is data from your agency,
and make a loan as safe, which is exactly what we've done with this 97% product, compensating factors including housing counseling, including higher FICO.
Okay, well, Director Watt, let's not just look
private mortgage.
Let's not just look.
All of those
you do recall I get to control Director Watt. Let me quote from the same document. Quote, default rates increase noticeably among loans used to purchase homes at LTV ratios above 80%. There is substantial data indicating that loans with LTV ratios of 80% or less perform noticeably better than those with LTV ratios above 80%. So notwithstanding, Mr. Director, and with all due respect, I understand what you're saying, but I fear what you are doing is, again, repeating the exact same mistakes that brought us here in the first place, and now you're in a contest with FHA to see who can be the nation's largest subprime lender. I fear we are going in the complete wrong direction with your policy. I now recognize the ranking member for 5 minutes.
Thank you very much. Mel Watt, I really wanted to spend my time on Affordable Housing Trust Fund, but I must step in here to basically ask, when we take a look at those that we would lend to with a 3% down, are we not talking about people who have shown that they pay their bills every month, they have basically good credit, they have not defaulted, they don't have any bankruptcies, they just are not able to save up a 10 to 20% as some more wealthier people are able to do. But these are good, hard-working taxpayers. Are these the kind of people you're talking about?
That's exactly the kind of people that we would be looking for, and we would pair that with strong credit scores, lower debt-to-income ratios, housing counseling, and private mortgage insurance, all of which would put together compensate for the fact that you are making a loan to somebody with a lower down payment. And we have no interest in going back to irresponsible lending, and it's part of our statutory mandate to make sure that that doesn't happen.
Thank you. I think that even though I don't have the data or the information, that a large part of our society fits into that category, and they deserve to be homeowners if, in fact, they are hardworking citizens who pay their bills, who have not had any problems. A 3% down payment should not cause us any problems at all. Let me get to the Affordable Housing Trust Fund. I'd like to commend you on your recent decision to follow the requirements set forth in the Housing and Economic Recovery Act of 2008 and lift the suspension on Fannie Mae and Freddie Mac's obligation to fund the National Housing Trust Fund and the Capital Magnet Fund. As you're well aware, we're in the worst rental housing crisis in this nation that has ever been seen. In the richest country in the world, it is unconscionable that there are 7.1 million American households for whom safe and decent housing is neither affordable nor available. In my own district alone, there's a shortage of nearly 43,000 affordable and available rental units for extremely and very low-income households. These critical new funds will not only add to the supply of affordable rental housing, but will also help to address homelessness and poverty across the country. Please talk to us about what factors you considered in coming to your decision to end the suspension of contributions to the funds.
Ranking Member Waters, I simply followed the statute. The statute tells us the exact circumstances or the criteria to be applied on the suspension of the contributions to the Housing Trust Fund, and it tells us the criteria that are to be applied under normal circumstances for funding, and that's whether they are contributing, whether the contributions to these funds would contribute or are contributing to the financial instability of the enterprises, whether they are causing or would cause the enterprises to be classified as undercapitalized, or whether they are preventing or would prevent the enterprises from successfully completing a capital restoration plan. Those are the statutory provisions. They're the same provisions that Mr. DeMarco applied appropriately, in my opinion, at the time that they were applied to suspend contributions to the trust fund. They are the same criteria that I applied appropriately, in my opinion, to reinstate them because circumstances have changed in that interim. So I simply followed the statute. That's all I did.
Well, thank you very much. That's very important to know because there are those, some of my friends on the opposite side of the aisle would have us believe that you have done something outside of your statutory requirements or mandates. And so I'm very pleased that you were able to clarify that. And I think it's going to be, if we can get this implemented, it's going to be very good for this country. I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from New Jersey, chair of our Capital Markets Subcommittee. He's recognized for 5 minutes.
So thanks, Mr. Chair. I'll follow up, Mr. Chairman, on your question with regard to the down payment. So obviously we're seeing a return to loose underwriting standards at the agencies. I'm sure, Director, you have read one of the largest banks in the country has publicly stated that a 3% down payment loans are simply too risky for them to originate. And yet here, on the other hand, you're having the agencies, you're instructing them to basically to take on more risk than the largest too big to fail banks. Now, every day we read in the paper how Wall Street banks are greedy and risk-taking, but it would appear that in this situation that you're doing just the exact opposite of what they're doing. They're being more prudential in this manner, and you're saying, as someone else once said, let's roll the dice. But the difference here is we're rolling the dice once again with the taxpayer money as opposed to private investors. Is that wise to do? To be riskier than the too big
Let me clarify that I haven't instructed any bank to make any loans that they think
well, not the banks.
Prudential.
You're instructing your agencies.
I've instructed that Fannie and Freddie that they can guarantee loans that are made responsibly that fit our criteria. The bank you're talking about, I think, is the same one that made the decision to acquire Countrywide. In following their experience, I can understand why they might be a little bit reticent to go back into that business, but that shouldn't control the entire mortgage market.
Well, reclaiming my time, they're
Representative
doing that on behalf of their investors, and I guess I'm speaking on behalf of the American taxpayers that we're concerned that where the taxpayer dollars are going to potentially be as we return to these very loose underwriting standards. Another point that we read in the paper is how after the last crisis, a lot of people felt they did everything right, and still they got burned at the end of the day in this crisis. And it seems to me that with the handling you're doing with the G fees, that's exactly the same thing you're doing now. With regard to loan level price adjustments, there is, as you know, a fair amount of cross-subsidization occurs on the pricing here. And what does that mean? That means that you have good borrowers with high down payments and better credit scores. They're being told that they have to pay the exact same fees as borrowers who have low down payments and have worse credit scores. Can you explain to me why you consider it's fair to tell people who have done everything right, saved their money, acted in a prudential way, that they have to pay the exact same fees and have the cross-subsidization there to those people who have done everything wrong, haven't saved, had bad credit, worse credit scores and what have you? Why is that fair?
I think your question illustrates the complexity of this issue sent to Representative Garrett. And all I did was suspend the increase in guarantee fees until we had a chance to evaluate all of the implications of it. And when we announce the guarantee fees, which we will do hopefully by the end of this quarter, we might take into account some of the things that you're talking about. But doing that without a thorough evaluation and consideration of all of the aspects of it, as you suggest we should do,
but it's pretty,
I think would have been irresponsible.
And you only suspended the decreases, I understand, and it seems to be pretty fair, plain on its face, that those who did good are being penalized for those that did poorly, and yet here we are a year later, and we're still in the situation of rewarding bad behavior and unfairly treating those who did good behavior. Moving over to some other items, we don't have a clock on here. The securitization platform. I mentioned earlier that there's bipartisan support as far as moving forward. One of those areas is the securitization platform. All parties, I think, seem to agree that we should be having this. And yet we see that the industry seems to be cut out of some of the development of the securitization platform. They are not really allowed in at the ground floor, the creation of it and the governance of this. Why are we, when we have a bipartisan initiative here, when we have both sides of the aisle and both chambers looking at it in the same manner, why are you cutting out industry? Is this another attempt by the GSEs to try to continue what they did before, to control the marketplace, to manipulate the going reforms, as opposed to allow those players in the future to be able to have a say in it?
Well, my response would be twofold. Number one, we're not cutting out private industry in our consultations. We're in regular consultation with private industry on the common securitization platform. But the more important point
do they have a role in the governance?
Is the one that I made to the chair when I discussed it with him. What I did was exactly what I thought Republicans really support, is de-risk this whole process by not trying to form a common securitization platform for a future that you all had not yet defined.
The time of the gentleman has expired. Members probably don't need to be reminded that we are not in our usual hearing room. Obviously, we are lacking the individual clocks. So to gauge your time, you need to look at the little color wheel, if you will, at the witness table, and I think you otherwise know the drill. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets GSE Subcommittee.
Thank the gentleman from yielding. Director Watt, I was pleased last year when you delayed your predecessor's decision to raise G fees. And as you know, your predecessor wanted to raise G fees even more in 4 states, one of which was New York. And New York and the other 4 have particularly strong consumer protections for foreclosures. And this would have needlessly harmed New York's economy and would have discouraged states from enacting stronger consumer protections. I think this was an important decision. We should be rewarding states that put strong consumer protections in, not penalizing. Now of course, what I'm hearing, the markets are telling me, or some of them, that they anticipate a possible decrease in the G fees rather than an increase. So can you just give an update on your review of the G fees in general, and do you anticipate that they'll be going down and not going up? I mean, that's what I was told. So
I don't know where that information would come from. We're still in the process of evaluating the input that we got in response to a request for input from the public on this issue, and we anticipate making a decision hopefully by the end of this quarter. It may slip into next quarter, but we're going to make a decision, and then we'll justify and outline the reasons for that decision. I don't think I have any information about whether they are going down, going up, risk-based. Might have some adverse impact on some of the states that you're talking about. But at this point, I think it would be premature to talk about what that result will be, because I don't even know what it will be. We're in the process of evaluating it.
well, in your deliberations, I hope that strong consumer protections for foreclosure are considered a plus, something the state should be rewarded for. I have another question. Director Watt, we've heard a lot about the Housing Trust Fund and the Capital Magnet Fund, some of which has been critical. But of course, we know the facts are that the Capital Magnet Fund has already had one successful round of funding in 2010, and it was a huge success through a public-private partnership model. $80 million in funding from the Capital Magnet Fund was turned into $1 billion for affordable housing, and I congratulate this effort. Now with your decision to start funding for both the Housing Trust Fund and the Capital Magnet Fund, there will be hundreds of millions of dollars for affordable housing every year. Can you talk a bit about the impact that you expect this funding to have on the affordable housing crisis that our country is facing? And can you talk a little bit about the public-private partnership that emerged to help magnify the money, and are you looking at more public-private partnerships, just in general, where this program is going for affordable housing?
Representative Maloney, to be quite honest, I didn't take any of that into account. Those are policy decisions that I think are legislative decisions, congressional decisions, and we don't have any control over, at FHFA, over the use of these funds. Those decisions are actually made at Treasury and HUD. Our decision related only to whether to fund it or not, and applying the statutory criteria to determine whether it should be funded or should not be funded. And so we didn't look at the use of these funds. We didn't look at the history of I'm not even sure I knew that there had been
Thank you for clarifying.
Project.
Thank you for clarifying. I'd like to ask you about the risk retention rule. As you know, the final rule inadvertently failed to exempt Freddie Mac's multifamily securities, even though it did exempt Fannie's multifamily securities. And I understand that FHFA is working on a possible solution for this already. Can you give us an update on these efforts?
The risk retention rule was not done by FHFA. That was a joint rulemaking process. So I'm not sure that we're looking at anything that's going to.
But the fact that it had inadvertently failed to exempt Freddie Mac's multifamily securities, even though it did exempt Fannie's multifamily securities, they should be treated the same. That's a.
Well, I would hope that whatever rule comes out would treat both Fannie and Freddie securities the same. That's what we're trying to work our way towards in the single security So
Thank you.
certainly
My time has
supportive of
expired.
that.
Thank you. Thank you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from North Carolina, Mr. McHenry, Vice Chairman of the committee.
Director Watt, thank you. Good to see you again, and always good to see you on the plane coming back and forth from your former district in Charlotte.
Congratulations on that beautiful baby.
Well, thank you, Mel. I appreciate it, and I appreciate your kindness and friendship over the years. And we've been able to have conversations even when we disagree about issues. And so I just want to ask you a few questions, but you know me fairly well, so I figured at some point you'll cut me off here. So it seems that we have some conflicting actions that you've taken. One is you suspend the G fees, right? And you move away from risk-based pricing. At the same time, you start up holding reserves for the Housing Trust Fund and allocating capital to the Housing Trust Fund. In one respect, you're conserving capital for an assessment, and the other, you're actually moving capital away from the enterprise. How do you reconcile that?
Representative McHenry, all I'm doing is following the statutes that were written by Congress and passed by Congress, and we're trying to do it as judiciously and prudently as we can. I'm not even trying to connect those two things. The Housing Trust Fund funding was an independent decision that was based on the statute. The G-fee decision was a prudence decision just to give us an opportunity to study the issue thoroughly, and we're doing that, and we don't know where we're going to get to on that. So I think judging where that might go at this point would be premature.
So under the statute, you have no choice. You have to allocate capital for the Housing Trust Fund?
Well, if the statutory standards are met, the contributions to the trust fund can be suspended. They were suspended in 2008 by the acting director at that time, and we applied the same principles under changed circumstances to reinstate them. That's all we did. But the Housing Trust Fund was not created by FHFA. Housing Trust Fund was created by Congress, and the decision to fund it or not fund it is based on statutory criteria.
Yeah, but most of us look at this and think that so look at Freddie being leveraged at 156 to 1, Fannie leveraged at 134 to 1, and think that the conditions are not right because you know the requirement to suspend the allocation of capital to the Housing Trust Fund shouldn't be justified under these circumstances with this type of leverage rate of these institutions.
That's not one of the statutory criteria that Congress set for evaluating whether to fund the Housing Trust Fund or not fund the Housing Trust Fund.
So is this an odd circumstance? Because you were outspoken about subprime lending in the private sector leading up to the crisis. You know, I heard you in debates here. I heard you on TV at home. That you said that these really high LTV loans were problematic, that this was deeply concerning, especially for those that didn't have savings, that a small fluctuation in the marketplace could cause problems. Do you have that similar concern? Because in many respects, you're making substantial decisions. No, you are making huge decisions. And so the consequences of these actions are real. I know you know that, but you know, is there that conflict looking back at what you said about the private sector versus the actions you're taking right now?
I don't think there's any conflict between what I said then and what I'm doing now. You need to make responsible loans, and this decision was surrounded by a bunch of compensating factors for every borrower that would make their loan as reliable a loan as a 10% down payment loan, a 20% down payment loan. And that's our responsibility, and I would hope that you all would rely on the same things that I said in advocating for reform in this area, to know that we are going to apply those principles and not sanction loans backed by Fannie and Freddie and the taxpayers that are not reliably expected to be paid.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you. Thank you, Mr. Chairman, and welcome, esteemed colleague, Director Watt. I just would like to revisit again the question that was made by Congresswoman Carolyn Maloney regarding the National Housing Trust Fund. I heard you when you said that it will be HUD and Treasury the one making the decision as to which projects to fund. My question to you is, when will that money make it out there? Have you had any discussion with those two agencies?
I have not had discussions with them about the application of the funding. That's their decision to make. Treasury makes the decisions about the capital fund. HUD makes the decisions about the housing trust fund side of it. So those are their decisions to make.
But do you have any idea as to when this money will start?
Yes, I can tell you that, because the process that we followed directs Fannie and Freddie to start setting aside the funds in January of 2015, and at the end of 2015, if circumstances don't reverse, then the monies would actually be allocated into the trust fund and the capital magnet fund and could be used. So there won't be any use of those funds during 2015. It would be 2016 at the earliest before the funds would be available.
Thank you. Director Watt, as part of their public mission, Fannie Mae and Freddie Mac maintain a duty to serve the entire housing market and support affordable housing preservation. In 2008, Congress asked FHFA to issue a rule to implement this duty to serve requirement. But while a proposed rule was issued in 2010, a final rule has not been promulgated as today. When do you plan to issue a final rule?
We are in the process of looking at that, and you're right. A proposed rule was issued in 2008 or 2009. It never was finalized because of whatever reasons. I don't know. We haven't tried to evaluate that, but we are going to have a duty to serve rule finalized, hopefully in the year 2015.
Thank you. In August, FHFA proposed a new housing goal category for small multifamily properties that have units affordable to low-income families. This effort, of course, is very important for places like New York City, where these properties are an important part of the housing stock. While your agency has set low initial benchmarks in an effort to take a gradual approach, please explain how this goal will be evaluated so that more ambitious targets can be set in the future.
We'll evaluate it on the same terms that we evaluate everything. First of all, make sure that the loans are safe and sound, and second of all, that they achieve the purpose of serving a group or a category of people who have been underserved, which is why we encouraged, directed Fannie and Freddie to look at how to incentivize small developments, because generally smaller developments have more of an orientation toward middle and lower income people. So that's included in the 2015 scorecard for Fannie and Freddie to continue to work to encourage those kinds of loans, and we will have in place an evaluation mechanism that makes sure that that's effective, or we will revise the expectations in the future based on experience, which is something that we do quite regularly.
Thank you. Thank you, Mr. Chairman.
Chair now recognizes the gentleman from Oklahoma, Mr. Lucas.
Thank you, Mr. Chairman. And my old colleague, Director Watt, I'd like to address the Federal Home Loan Housing Finance's proposed rulemaking regarding membership requirements for federal home loan banks. And I'm concerned that the proposed rule would unnecessarily harm a significant number of community financial institutions in Oklahoma and across the country by limiting membership in the federal home loan bank system. In recent years, it's been increasingly difficult for these institutions to provide mortgage financing needed in their communities, and the federal home loan banks have served a very critical role as a source of liquidity during these challenging times. I guess my question, Mel, is why propose such regulation at a time when community banks and credit unions are in need of every credit resource available to them to serve their communities? Or as Congressman Watt would have said, what's the problem you're trying to fix with this rule?
Well, there are some potential problems that we're trying to fix to make sure that the federal home loan banks meet the statutory purposes that have been set. First of all, you don't want anybody to be a member of the federal home loan bank system and get the benefits of it unless they meet the criteria that Congress has set. And we were concerned that some of the members of federal home loan banks were not meeting those criteria. So, I mean, I can go into more detail. I can give you a complete outline of the rationale, but we're trying also to do this in a way that does not have the adverse impact that you're talking about.
But as I understand it, Director, under the present system, once an institution meets the requirement to participate, they still have all the obligations and all the standards that have to be met by any home loan bank board institution. There's just some concern out there in the countryside, and perhaps in the hallways of Congress, that there's more to this than just an ongoing set of standards, that perhaps, since the administration's not really been able to legislate much in the last 4+ years, that this is another effort to change how the system works by rule and not by law, since I don't think this institution would pass a bill to do this. So I guess my question is this an effort by the administration to be able to channel and steer how these institutions use this resource?
First of all, let me be clear with you, as I've been with the administration. I'm not part of the administration. The Federal Housing Finance Agency is an independent regulatory agency. We don't play out the administration's policy. We follow the statute, and that's what we're doing in this case.
But once again, to paraphrase Congressman Watt, the folks what brung you are the folks what keep you there, i.e., the question still goes back to, is this an effort to try, through the rule process, to determine how these resources are used and, in effect, to put the institutions that are a part of the Home Loan Bank Board system on a rather short leash?
We have no agenda other than making sure that members of federal home loan banks meet the criteria that Congress has established for membership. The one that, and I know this is a controversial issue because we put out the rule, we got 1,300 comments. I mean, that's almost unprecedented. We're going to go through every one of those comments and evaluate every single one of them. And most of them, to be quite, I would say probably 90% of them appear to be against the proposed rule. So that obviously, we've touched a nerve.
It's good.
But we are going to apply the statute and try not to have the adverse impact that people are contemplating might be a result of this rule.
Mel, you've always been a man of your word. I take you as a man of your word. But we're in an environment where a lot of things are going on in very interesting ways, and I would just note that I would hope the committee would be very sensitive about doing anything to a model that has worked really well and is working well in a particularly tough set of times for those institutions.
I agree with you.
I appreciate our friendship, and many of the underclassmen weren't here when you and I worked to help whoever the ranking member or chairman was at any given time over two decades almost. So as we helped leadership, I'm going to try and help you, sir.
Thank you so much. Great to see you again.
Yield back, Mr. Chairman.
Gentleman yields back. The chair now recognizes the gentleman from Massachusetts, Mr. Lynch, for 5 minutes.
Thank you, Mr. Chairman, and I want to welcome back Director Watt. Good to see you again. And as you can see, some things have not changed here in terms of how we might view affordable housing and the way FHFA works. There was a great article yesterday in the New York Times by Cersei and Bob Gebeloff. It talked about how the middle class is continuing to shrink, and this phenomenon is resulting in more people being squeezed into the very bottom of income earners. That's obviously putting a lot of pressure on affordable housing, and which is where you come in. According to the National Low-Income Housing Coalition, we need about 7 million more homes nationwide that are affordable and available to extremely low-income households and those with incomes at 30% or less of the area median income. I know that in my home state of Massachusetts, there's a shortfall of about 175,000 affordable units, and in my district, it's about, 16,000 units. There are a couple of tools that you have, and I'm happy to see that they are beginning to be used, the Housing Trust Fund and the Capital Magnet Fund. I think they can be part of the solution. And now I know that you're following statutory directive in terms of the Magnet Fund, but can you talk a little bit more broadly about how your affordable housing goals are consistent with the reality that we're seeing out there? I know that the situation seems to be getting worse for that tier of people that would benefit from access to affordable rental housing. Never mind the 3% down payment on purchasing housing, but just that there are folks that I think have resigned themselves that they are not home purchasers, that they are renters now. And how does your affordable housing goal, how does it help those people?
Well, first of all, we haven't finalized the affordable housing goals yet. The rule is in process, and we're evaluating comments.
Well, how do you anticipate your goals once you figure them out?
So here's the way we think of this. First of all, we want to make on the ownership side people who can afford to pay a mortgage, make it available to them. On the rental side, we want to make sure that affordable housing is available in the marketplace. There's actually a very robust multifamily market on the high end, but not so much on the affordable end, which is why when we wrote the scorecard criteria, we exempted from the $30 billion, or whatever the figure was, I can't even remember what it was, cap, affordable housing developments, to try to encourage Fannie and Freddie to be more involved and active in getting into that space, which is underserved by the private sector. So that's what we've done, and the rule itself will try to build on that and incentivize that. You are right. There are a lot more people renting now than had been historically renting. The rental market is robust, and there are not enough units to serve that market.
Okay. See, my time is just about expired. I yield back, and I thank you.
Gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Nagelbauer, chair of our Financial Institutions Subcommittee.
Director Watt, good to see you again. You mentioned a couple of times, I want to talk about G fees first, that you're currently studying the G fee issue and will make a determination. It was my understanding that a study was done prior to the previous director issuing a directive to increase the G fee to 10%. So I guess the first question is if we've already studied it, why are we studying it again?
Well, I don't think we should ever stop evaluating issues. I was not a party to the study that was done before. We obviously are taking that study and any conclusions that it reached into account in reaching our conclusion. But we've been very transparent in seeking input about how these G fees should be set, what criteria should be applied in setting the G fees. Should it be about just about protecting against the risk that that Fannie and Freddie are assuming? Should it be about capital formation? Should it be about attracting private capital into the process? Has been very transparent, and
so you decided to study it again, is what?
Yes.
Okay. So the cross-subsidization issue that the gentleman from New Jersey brought up, I think, is an issue that I'm interested in as well. And in fact, I had conversations with your predecessor in that there are some states that have very stringent foreclosure procedures that in many cases keep the people that loan the money in good faith not months from getting their property back if the person's not paying, but in some cases years. And so I think that in those cases I support that is a higher risk to those entities and those where those foreclosure rules are very consumer oriented. And so I'm not opposed to those states deciding that. I think that's their right. But I think what they have to also understand is when you make it so consumer oriented and that you penalize the people that are loaning the money and causing losses, and what we've seen in many of those states where they had it's very difficult to get your property back, that those properties were stripped of windows and sinks. And so I just want to say to you that I think pricing your G fees on risk is important. Now, one of the things that you allude to in your report, and in your written testimony, and you brought it up as well, is you've been doing some risk transferring. And so I guess the question is, if you're not taking a risk, you don't have to transfer it. But I wondered if you could give the committee some idea how many basis points it's costing to transfer that risk. Now, what is the pricing on those transactions that you're doing that would to give us some idea of what's costing to reinsure those risks?
I can't tell you in basis points, but I can tell you that one of the criteria that is always applied is that a risk transfer must be done in a commercially reasonable manner, and it can't be just giving away assets because that would be inconsistent with our conserve and preserve mandate under the conservatorship statute.
Well, I think that where I'm trying to get to, though, is in the current situation where Freddie and Fannie really don't, they need to make a profit, but there is really no market forces in place there to determine, whether what the value of these entities are. And so the question is if you are transferring that risk, it would be helpful for us to know that, because that should also influence what your G fee pricing is going to be. In other words,
we have that information. I don't mean to suggest that we don't have that information. We have the information on every risk transfer transaction that has been undertaken, the cost, what the models say the value was, what Fannie and Freddie made on the transactions. We have that information. But you asked me what are the number of basis points. I mean, that's information I wouldn't have off the top of my head, but we can provide more information to you if that's what you need.
I would like that. Final point I would make is back on the down payment. I think it's erroneous, kind of ironic that, maybe erroneous too, but it's ironic that, we made FHA increase their down payment to 3.5%. And it looks like the two of you have got a race here of seeing who can get the most market share here. And so you've kind of won up FHA by going to a 3% down payment when they have a 3.5% down payment.
Well, first of all, you should be clear that we are not in competition with FHA.
Sure you are.
We are not. The market the market is going to go to whoever gives them the best deal. We know that, but we're not competing with FHA. We're trying to provide liquidity in the market, which is what our mandate says we're supposed to.
Time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you, Mr. Chairman, and welcome, Director. I feel good and I feel proud to see you sitting where you're sitting and doing what you're doing for the people of this nation. Congratulations. I think you're doing a great job. I'd like for us to revisit for a moment the Housing Trust Fund. And I'd like to clear up some things so that folks will understand. First of all, both you and I were here sitting on this committee when none other than President George W. Bush authorized. He authorized this Housing Trust Fund. And if you recall, when he authorized it, he said that this is perhaps the best tool that we could use to help get housing for our most vulnerable population. So I want to set the record straight that this is both a Democratic and a Republican initiative. And secondly, you have moved to reinstate the payments largely following the orders of us in Congress. Because we, during the economic recovery, we put 3 criteria in for suspending it. Those criteria now no longer exist for the GSEs. And so you are operating on this trust fund within the authority, first of all, that President George Bush gave you, and secondly, what the Congress of the United States reinforced. I just want to make sure that is clear. Now I want to talk about one other thing because I think it's very important, and that is principal reduction. That is really at the core of helping people, and all the evidence is in that is the case. Recently you went to, and that's another thing I want to commend you for, because you go out where the problems are. You've been out in the nation. You've been to Atlanta, and we certainly appreciated you there with the HARP program. But you went to Detroit, where this problem is very pronounced. And I think you articulated there your concern about being able to use the necessary tools for principal reduction. I think that is the core of it. Would you mind addressing that within the light of what you said and how important principal reduction is?
Well, it allows me to go back to a point that I made with Representative Neugebauer. This is one of those issues that I've received a lot of second guessing about, because there was a study done about principal reduction before I got to FHFA also. And I haven't done principal reduction either. We're still studying that issue, just like we're still studying the G-fee issue. And what we're trying to do on principal reduction is find a place where it is beneficial to borrowers and not negatively net present value to Fannie and Freddie, right?
No.
And there are some instances in which that is the case. It's beneficial to borrowers and not negative to Fannie and Freddie. And when we find that niche, that's when we're going to make a decision about this. Now, in Detroit, we are under the Neighborhood Stabilization Initiative, testing some things there to see where that sweet spot is, because if you have a whole neighborhood that's sitting there with vacant properties, half of the properties vacant, it pulls down the value of the other properties in that neighborhood. So we're trying to craft something that will work for the enterprises and for the borrowers.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman, and congratulations to you, Mr. Watt, on your appointment. And I don't know whether to congratulate you or empathize or sympathize with you, but we're glad to be you're here today. So, to follow up on a couple of the comments that were made earlier with regards to the capital that you have in the GSEs and the ability to provide stability. One of the things that I'm looking at here as I read through this is, your past dues in Fannie Mae and Freddie Mac right now are just a little less than 2% of both of them, so that's good. Am my mic not on?
I hear you, but I'm having a little trouble picking up all of your sentences.
Okay,
I'm
all
sorry.
right. I'll hold the microphone a little closer then. I apologize. Your past dues for Fannie and Freddie are both just a little under 2% right now, which is very good. But your capital is at 0.4%. We're supposed to be at 2%. And so I guess my question is, in your testimony, you say enterprises do not have the ability to build capital internally while they remain in conservatorship. How do we solve the problem of additional bad debts popping up? And I guess another subsequent question to go with that, do you have any lawsuits pending that can bring in cash to add to your capital account? Or whenever a lawsuit's filed and you win it, does that money go to the treasurer? Does it go into your... How do you solve the problem of having enough capital to absorb the losses is my question.
We can't build up capital because we are operating under a preferred stock purchase agreement with Treasury in conservatorship that sweeps all of the profits that Fannie and Freddie make to the taxpayers.
Right.
That was the quid pro quo for.
If that's the case, though,
keeping them from going, Fannie and Freddie from going into.
If that's the case, though, how do you, whenever further bad debts losses occur, where do you take those losses? Eventually, just go to the treasurer and ask them to write a check to build more capital in the account.
That's what would happen under the preferred stock purchase agreements. Basically, the taxpayers are backing Fannie and Freddie, and they will be until GSE reform is done.
Okay.
And we can't do that. We don't do GSE reform. That's why it's so important for Congress to act on GSE reform.
I saw that you had some nice income figures. I assume part of that is also the settlement of lawsuits with different entities. And
it has
my
been
question
substantial.
Is, do you have lawsuits pending now?
There are 2 more lawsuits pending.
Okay, when you win those lawsuits, do those dollars go to your capital account or they go to the Treasury?
They will go into Freddie and Fannie's account, and if at the end of the year there are profits, they will be swept to Treasury. Yes.
Very good. Well, one of the concerns that I have, excuse me, also is with regards to the way that you're pricing things and the way that you are changing some of your rules and regulations. Having been in the loaning money for 35 years, I can tell you that there are certain tenets of lending. You can't get away from them, no matter how much you want to do it. Certain things have to happen. If they don't, you lose. It's just that simple.
Risk. You're right.
It's just that simple. I mean, everybody wants to say, well, I can slice the bread thinner. I'm a little smarter than the next guy. All I got to do is just tweak here, tweak there. I'm sorry. It doesn't work. After 35 years, of stubbing my nose against certain things, stumbling over this. There's certain tenants, they got to be there, that's it. And so my concern is that when we change these things and we loosen rules up, as you've seen over the last 6 years, Fannie and Freddie have had a resurgence. They've actually now are profitable. They're turning a profit. So why in the world do you go back now and want to change those sound tenets of lending to loosen it up and head down the same path that caused the problem before?
Well, first of all, you are absolutely right. We are in the risk business, and there's no way to get away from risk. You can make any loan at some point can become risky. So what you do on every loan that you try that we back, we try to assess what are the risks associated with this loan, and we try to minimize those risks. Now, you can't eliminate risk.
With respect, I've got one more question. I see my time is about up here. With regards to in your testimony, you also want to try and move a lot of stuff to the private sector, and I think that's laudable. That's a thing we need to be doing. My concern is, though, that if you continue to compete with the private sector by lowering guarantee fees, by loosening lending standards, it makes it more difficult for the private sector to step in and do that. Would you agree with that statement?
Yeah, I agree with it generally, but at the same time, our responsibility is to assure a liquid housing finance market in the interim until you all do GSE reform. So we're balancing risk and availability of housing finance, which is what I said in my opening statement.
But you're still competing.
Time of the gentleman has expired. Chair now recognizes the gentleman from Texas, Mr. Green, ranking member of our Oversight Investigation Subcommittee.
Thank you, Mr. Chairman. I thank the ranking member as well, and Director Watt. It was a preeminent privilege to serve with you for nearly a decade in Congress. You were always a voice of reason, and I see that you continue to be that voice of reason. I'd like to talk to you about the FICO score that the GSEs are required to adhere to. Under this current FICO standard, we have a circumstance that allows bad credit for utilities and rental payments to be utilized when ascertaining a score, but the good credit that one has for these very same utilities and rental payments is not utilized. And I'm mentioning this to you because I think we need a more inclusive model. I'm not talking about doing anything that would in any way impair or prevent a good FICO score from being developed. I just think that it's fair. We've used this term fairness this morning, fair play. Seems fair to me that if you're going to use the adverse information, that we should use that information in a positive way when it is available for Fair Isaac to score. These FICO scores, as you know, are exceedingly important. In fact, they're everything when it comes to getting a loan. So can you please give me just a bit of intelligence on this in terms of how we might work with your office to try to expand and have a more inclusive credit scoring model?
Well, first of all, you are right. Credit scoring is one of those areas where there's been
Director Watt, is your microphone on?
Did it go off? I'm sorry.
If you could pull it a little closer too, please.
Would you add these 30 seconds to my time, please?
I'll consider.
Thank you, Mr. Chair.
Some things don't change in this committee. So there are alternative credit scoring models that are beginning to be out there now. FICO is updating its credit scoring model. Vantage has a credit scoring model. There are several. And what we've done in this year's 2015 scorecard is we've instructed Fannie and Freddie to evaluate these alternative credit scoring models to see if we can get to a better place in this area. Not a race to the bottom. We don't want credit scores that get more people the ability to get loans and are not reliable. So we ask them to to evaluate the reliability of it. We asked them to evaluate the operational challenges that would go with implementing alternative credit scoring models. So this is an area that we're working aggressively on this year. We started last year in response, well, not in response, but a number of people on this committee have written to me about the alternative credit scoring models, both on the Republican side and the Democratic side. It's not a partisan issue. So we're trying to figure out how we can do this, but do it in a reliable way and in a way that operationally doesn't create angst in the entire market, because what we do in this space could have some significant implications.
Well, thank you for exploring the possibilities, because I concur with you. There are alternative models that seem to indicate that we have some opportunities. Let me move quickly to the Housing Trust Fund, because I think it's important for us to explain that when we, and you were here, when we developed the formula, if you will, we put a trigger in. And that trigger was placed there to prevent a person who might be in your position, who might have opinions that would vary from what we thought the law should require. So the trigger required that we not fund because of circumstances, and then it requires that we do fund because of circumstances. It allows circumstances to dictate the actions of the director as opposed to the will of the director. I think it was a pretty good idea then. Seems like it's a pretty good idea now to take the director to the extent that you can out of play. And this is no disrespect to you. It's just that we were trying to protect the process that could help people that I was sent here to represent, a good many of whom don't have as much in assets and liquidity as others.
Very brief answer, please.
I'm happy to follow the statute that was written, and that's exactly what we've done. I stand by that decision. Yeah.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Royce, Chair of the House Foreign Affairs Committee.
Director, congratulations. Good to see you here.
Thank you. Good to see you again.
Thank you. As you know, my concerns have always gone to these issues of moral hazard and over leverage, whether it was a Republican administration or a Democratic administration. But I think until 2007, we probably could have considered some of my concerns hypothetical or philosophical. But after 2007, I think that over leverage issue sort of proved a point. And looking at the headlines read, government keeps pushing mortgage guarantees as risk index rises. Here's another headline. FHFA orders GSEs to start supporting affordable housing trust funds. Now, surprisingly, the year here is not 2005, it's 2015. And so we find the FHA today engaged in this race with Fannie and Freddie to see who can more swiftly crowd out the private sector, who can assume more risk on behalf of the American taxpayer. And I would just point out that this is kind of a frightening race here, because in my view we've seen it before. The FHFA has joined sort of a moral hazard problem here. And in December, you announced that the GSEs should begin to put more money into the coffers of housing advocacy groups through the Housing Trust Fund, established under the Housing and Economic Recovery Act. And you made this move despite the fact that Fannie and Freddie have yet to repay a lot of the money due to the American people. We can argue about whether it's $200 billion but there was a lot of money lost at the end of the day because of over leverage. So it is difficult to see how you can argue that, as it is required by law, the GSEs are financially stable enough to begin the transfer of money to housing groups. Let me show you the ratios here, and I think this was pointed out earlier. Fannie Mae leveraged at 341 to 1. Now that's a capital ratio of 0.29%. Freddie Mac, 153 to 1, and an equally concerning leverage ratio of 0.65%. You remember a decade ago, I was arguing about 100-to-1 leverage ratios. This is excessive of that. And you said earlier in this hearing that the leverage ratio is not something the statute requires you to look at when suspending allocations. I've got a different reading of that statute that I'll share with you. What the statute requires is that you shall suspend allocations, not may. The statute reads, shall suspend allocations if they would contribute to the financial instability of the enterprise or would cause the enterprise to be classified as undercapitalized. So, in reality, the statistics cited earlier, do come into play. So, Director, how can the enterprises be in this state with these leverage ratios, in one case 341-to-1, and not be deemed both financially unstable and undercapitalized? That's my question.
So, first of all, we put in place prudential stops if circumstances go back in the other direction. If we ever have a draw on the Treasury, that would automatically stop funding of the Housing Trust Fund.
Right, but it's already undercapitalized is the point I'm making.
We don't have, when Fannie and Freddie were put into conservatorship and the preferred stock purchase agreements were entered into with Treasury, that suspended the capital of Fannie and Freddie. Now, if we were building up capital, I understand exactly what you're saying, but those two criteria don't apply anymore because they are in conservatorship. Every dime is going to the taxpayers if there is a profit.
There's statutory language here that requires an end to the allocation. I think it's very straightforward, but I'll close with this. Today, I, along with many of my Republican colleagues, will reintroduce the Pay Back the Taxpayers Act, and this bill will ensure that money coming in from the GSEs will go to the taxpayers. In other words, will go to address this issue instead of being diverted to the Housing Trust Fund. But thank you, Director. Good to see you again.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Cleaver, ranking member of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman and ranking member. Thank you for being here, Mr. Watt. There's been a lot of discussion about the 3% down, and I'm not sure if the suggestion is that 3% down is reckless. I was looking at a study. VA has a 0% down and a lower foreclosure rate than the prime lenders. So is there any evidence that 3% is going to cause more foreclosures if 0% is not causing foreclosure? I mean, what is it about 0 to 3 that creates this problem?
Well, I think, Representative Cleaver, the challenge is to look at lenders and make a determination. When the down payment is lower, there's the potential that it could be a riskier loan. But when you pair that with other compensating factors, which this product does, you offset that additional risk. And that's exactly what we've done. Lending is about assessing the ability of people to pay. And what most people don't realize that even probably 90% of the people who are underwater have no equity in their mortgage at this point are continuing to pay their mortgages, right? So that's not a criteria of whether somebody is going to pay, whether you've got 3%, 10%. You know, it's about whether you want to have a home that you own, right? And so you assess those criteria, and there's substantial studies that suggest that that confirm that housing counseling homeownership counseling makes people better borrowers, more reliable borrowers. This program that's one of the compensating factors. And if all else fails, you've got to have private mortgage insurance to back the loan. So it's not as if we've created a risky situation. These are not the loans that had no documentation, no resets after 90 days or 3 years. I mean, these are not risky loans, and we have made that assessment based on research, not based on politics, based on research. We have made that assessment, and I stand behind this decision. That's why I was happy to come here and have the opportunity to talk about the prudential compensating factors that we have put around this thing to make sure that you all understand that my philosophy has not changed. If somebody can't pay a loan, they shouldn't be given the loan. If you look down there and say this person can't pay this loan, it would be irresponsible for us to say that we should be making loans to those people, or that Fannie and Freddie should be backing those loans.
Yeah, I think I heard you clearly.
He's hard to understand.
Maybe I have time for a quick question. Let's remove the sociological issues if people want to connect that to the loans. The economy is not healing for some people. We still have stagnant wages, and in fact, hourly wages are actually ticking down in terms of keeping up with inflation. So if we're having stagnant wages and we're trying to heal the economy, and housing is a significant part of healing the economy, having a housing market that's healthy, does it make sense then for us to put interest rates and down payments high when we're trying to get the housing industry healed? I mean, can we heal the housing industry without getting more people to buy houses? People who qualify, credit-worthy people. Is there any other way to do it, to get people to buy more houses without making it affordable?
Congress has given us this mandate. Do lending back loans that are safe and sound and provide liquidity in the market. We are constantly balancing those two objectives. That's what we're in business to do, and that's what we're planning to continue.
Time of the gentleman has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizenga, chair of our Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman, and welcome back to, well, I guess this isn't quite home turf since we're visiting somebody else's committee hearing room while ours is under some much-needed repair. But almost 2 years ago, I had a chance to ask your predecessor, Mr. DeMarco, about FHFA's intentions as it related to new regulations in the lender-placed insurance market, the LPI market. And I urged Director DeMarco to make sure that any such regulations met a test of producing a fair and open marketplace for providers of LPI and for, more importantly, even the consumers, which in turn would produce potentially lower prices for these consumers. Can you please provide the committee with any kind of update in this particular area that has gone on? I know at that time he was looking at some rules. So,
first of all, Acting Director DeMarco is to be commended, and FHFA is to be commended for getting into this space, because there was a lot of abuse going on. There were virtually no controls. And FHFA addressed some of those inappropriate practices by directing the enterprises to prohibit servicers or servicer affiliates from receiving compensation in the form of commissions for placing insurance, because there was a perverse financial incentive for placing insurance in these circumstances with affiliates or people who were paying commissions. And we've formed a working group because this is an issue that, that is not only an FHFA issue, it impacts everybody who has a mortgage in this country. And we've set up a regulatory working group consisting of 14 state insurance regulators, the National Association of Insurance Commissioners, and 8 federal regulatory agency representatives to try to figure out how best to attack this problem.
And when was that formed?
Beg pardon?
When was that formed?
That was formed in 2013.
Okay. And is there a status update?
They've had 7 meetings up to this point, and in the meantime, things have improved because of these interim requirements we imposed on Fannie and Freddie, but we are continuing to work on a set of guidelines that would apply across the whole
do you have a timeline of when that will be completed? I mean, I think anything that's in limbo like that is probably needs to get wrapped up.
It's hard to set a time frame on a lot of these things, as you've noted. We're going to do it as soon as they come out with a set of recommendations. We're evaluating those, and we are.
So they have not come up with those recommendations as of yet. They have not come up with those recommendations as of yet.
It's in the 2015 scorecard.
Okay.
And so we expect that to happen sometime during this year.
Okay. All right. We'll follow up on that. And I'm going to ask you a question as I was going back over some of the testimony from back then. I'm going to ask you a question that I asked Mr. DeMarco as well. Is a 30-year mortgage necessary, and why?
Now you got me into congressional territory. I think that's a decision that really is more appropriately made. I can tell you that demographics are changing. People are a lot more mobile than they used to be. And a 30-year mortgage was bottomed on people staying in the same place for 30 years, or that assumption, and on the fact that it would get you a lower payment if it. So there are a lot of factors that go into that, but that's not really a decision that FHFA is going to make. That's a decision that I think is more appropriately made in the legislative context.
Personally, I think it might be the private market space that is probably where most of that is.
That is true also.
I don't know if you're aware of this, and I'm going to quote this. The Methuselah of mortgages has arrived, the 50-year home loan. That gets me very, very nervous when we are having these types of time frames out there, but appreciate it. Thank you, Mr. Chairman.
Mr. Chairman, just for his information, we don't allow that Fannie or Freddie to back 50-year mortgages. 30 years is our limit, so be clear on that.
Well, listening to your comments, it was one of the few times I agreed with you. I was about to yield you more time, but instead we will turn to the gentleman from Texas. Mr. Hinojosa is recognized for 5 minutes.
Thank you, Mr. Chairman. I apologize for not being here earlier, but I was at another committee where we were reorganizing. I want to say good morning and thank you to my former colleague, Director Watt, for being here today to give the Financial Services Committee an update on the changes to the housing finance system and FHFA's role going forward. I believe that Fannie Mae and Freddie Mac share very important goals, such as ensuring liquidity in the mortgage market and promoting home ownership. However, due to their financial trouble in recent years, we have seen attempts to not just reform them, but wind them down completely, and I don't agree with that. I would like to go right into the questions, and Director Watt, last year President Obama made remarks that he would like to see Fannie Mae and Freddie Mac wound down and replaced by a government-backed mortgage bond insurer. Can you tell us where you stand on that proposal, and do you think this will negatively or positively affect the home buying market?
Representative Hinojosa, that's a subject that I am not going to express an opinion about. That's a legislative, congressional decision. And just to kind of put it in perspective, when I got to FHFA, there were multiple visions or views about GSE reform. And I kind of took FHFA out of that discussion because we were sending mixed messages. It wasn't part of the statutory mission that FHFA has, which is to, in the present, guarantee liquidity and safety and soundness in the market. That is a congressional decision, not an FHFA.
I respect your answer, but I want to commend you because since FHFA's conservatorship of Fannie Mae and Freddie Mac, we have seen a stark change in the finances of GSEs for the better, and we thank you for your leadership and your being able to make those improvements. I especially like the $38 billion in extra funds that you gave our nation's treasury. I have another question. Late last year, Fannie Mae and Freddie Mac announced new lending guidelines designed to help more low-income and first-time buyers afford homes, including a reduction of the minimum down payment for a home from 5% to 3%. What other proposals is FHFA looking at to encourage first-time home buyers, and how is the agency making people aware of these initiatives that I have mentioned?
Well, we have a number of things that are already on the books. I don't know that we're looking at any new proposals that I would indicate to you, but we have homeowner modification programs. We have the HOP program, which is a refinance program for people who are underwater but have been regularly paying their mortgage. And the 97% loan product, I think what we've tasked Fannie and Freddie to do is to in this space evaluate how we can make credit available to credit-worthy people, and that's part of the 2015 scorecard. It was part of the 2014 scorecard. They operate in this area regularly. We evaluate what they propose. It is all research-based, and we try to make good, prudent decisions in the interest of safety and soundness and the interest of liquidity in the market.
I want to make my last question. What steps, if any, is FHFA taking to ensure that private capital is re-entering the market? Because I can see some months where the numbers being, the people are buying new homes or used homes has been going up, and then suddenly they went down. So this is important to me on the private capital re-entering the market.
The major way is that we are doing aggressive risk transferring to the private sector. We're not holding on to these loans. We're transferring that risk back into the private sector, and we've tripled, quadrupled, really, the risk transfers since I've been there.
Thank you, Mr. Chairman.
Time of the gentleman has expired. Chair now recognizes the gentleman from Wisconsin, Mr. Duffy, Chair of the Oversight and Investigation Subcommittee.
Thank you, Mr. Chairman, and welcome again, Mr. Watt. Over the course of your testimony, you have indicated that you're following the law and following the statute, which we appreciate that because we always don't think that laws and statutes are followed. I want to follow up on Mr. Royce's line of questioning in regard to the funding of the Housing Trust Fund. You're obviously aware of Section 1337, and basically we have a discussion about whether the GSEs are well capitalized, and if they're undercapitalized, you really can't fund the Housing Trust Fund. Would you agree with that?
Yes. Well, no.
Kind of.
Not undercapitalized, but if they're not making a profit, I absolutely agree with you.
They have to be well capitalized.
Capital is a whole different issue that basically when the Fannie and Freddie were put into conservatorship, the capital considerations went away because basically we don't have any capital at this point.
One of the drawbacks of statute says you don't get to split hairs. The language is usually pretty clear. And you'd agree that the language in the statute requires that the GSEs are well capitalized, not undercapitalized, correct? Before you can fund the Housing Trust Fund, you have to find that the GSEs are not undercapitalized, correct?
No, I don't think that's the case.
Do you think the GSEs...
It says I can't make a decision that causes or would cause the enterprises to be classified as undercapitalized, but the decision about capital was not on my plate. That was in the letter that I wrote that reinstated the contributions. I specifically said that that provision nor the third provision was applicable anymore because they were in conservatorship. It was the only the first provision that that was applicable to my decision.
Can you direct me to the section of the statute that says unless the GSEs are in conservatorship?
Well, there's nothing in there that says unless they're in conservatorship, but we...
So where did you come up with that? Where did you come up with that?
The conservatorship statute tells us what authorities we have in conservatorship. It wouldn't be in the Housing Trust Fund statute.
So is your testimony that trumps Section 1337B?
I think the preferred stock purchase agreements trump B2, yes.
So you're saying, just to be clear, that 1337B, it doesn't really apply and that you have the authority to fund the Housing Trust Fund. Is that
that's correct? Yes. If I hadn't concluded that, I wouldn't have done it.
Would you mind sending me the legal analysis on that, because the statute seems pretty clear, and we want to follow the statute per your testimony. So if you would help me out on how you've reasoned,
I'd be happy to do that.
That would be wonderful. Just quickly, in regard to the Housing Trust Fund, how is that going to be funded? How's it going to be funded?
How is it going to be funded? Out of the profits of Fannie and Freddie.
Where do those profits come from? Is there any kind of a surcharge or tax or assessment?
No. In fact, the statute specifically says there cannot be a surcharge to fund the Housing Trust Fund, and we have put out a rule that ensures that does not happen.
Will it increase the cost, do you think, to the end home purchaser?
No,
in the form of an interest rate?
Because the statute says we are not allowed to increase the cost to the borrower.
I know statutes say a lot of things, but it sometimes is applicable and sometimes not.
Sometimes, all the time, we try to follow the statute, though.
I appreciate that. Mr. Garrett and I had sent you a letter in regard to the GSE's lobbying, and this was sent on December 11th. And we haven't received a response from you yet. Did you receive that letter?
Yes, sir, I did.
Can we expect a response in regard to?
Yes, sir, you can.
Can you give me
you might have gotten it yesterday, but I thought you all would say that we were doing it just in response to the hearing.
We probably would have.
We take every inquiry we get seriously, and we try to go and get to the bottom of what whatever charges.
Are you going to continue the ban?
But we will respond.
Are you going to continue the ban on GSE lobbying?
Beg your pardon?
Are you going to continue the ban on GSE lobbying?
Yes, absolutely. We're continuing the ban on GSE lobbying.
Thank you. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Clay, ranking member of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and welcome back, Director Watt. How is the family?
The family is good.
Good.
Thank you. It's going to grow.
Okay. Thank you for being here. Although there are operational costs involved in requiring the GSEs to update the credit scoring model that they use in their seller service guidelines, The GSEs are still using the FICO Classic model in their seller servicer guidelines, despite the fact that newer versions of FICO, including FICO 08 and FICO 09, are currently available in the marketplace. Given this, how concerned are you that the failure to compel the GSEs to use their most updated credit scoring models in their seller servicer guidelines may not be giving the GSEs the best available assessment of whether a borrower is a good credit risk and may be unnecessarily restricted credit to eligible borrowers?
Well, your question illustrates the difficulty of this because to move from FICO Classic to FICO 8 or 9 is the same challenge that we have to move from FICO Classic to Vantage or some other credit scoring model. So what we've done is in the 2015 scorecards, we've instructed Fannie and Freddie to evaluate both the feasibility and the operational complexity challenges related to using updated or alternative scoring models. Now, feasibility is, are these credit scoring models better than the ones than FICO Classic? We think they are, but we have to document that. And then operational feasibility relates to what would it take to change not only Fannie and Freddie, but the industry to using alternative credit scoring models, because turning that ship is a major task, right?
So have the credit scoring agencies, have they been receptive, or have they pushed these new versions?
Yes, they have. Both FICO has updated its credit scoring model, and Vantage and others we are regularly talking to them about this process.
I see.
Yes.
All right. Let's move over to the to HARP. Director Watt, FHFA recently launched an interactive map showing that there are more than 722,000 eligible households nationwide that could still benefit from HARP, a program that allows certain homeowners with GSE-backed loans to refinance into mortgages with lower interest rates, thereby reducing their payments by as much as $200 per month, while also reducing risk to the taxpayer by reducing their likelihood to default on their mortgages. What is your agency doing to ensure that households are aware of this refinancing program?
Well, first of all, we are very proud of that map because it gets you to the people who are eligible for HARP refinancing. 3.3 million people have already taken advantage of HARP. There are over 700,000 who would still be eligible for it, that would get an advantage of taking advantage of it, and we're trying to get to those people. Now, let me just emphasize that these are people, every single one of them, all 3.3 million of them, have no equity in their home. Their homes are underwater, and they have been continuing to pay their mortgage despite the fact that they are underwater. That takes us back, this notion that you got to have a down payment, you got to have equity in a house for people to continue to be reliable homeowners and borrowers, is just in the face of all of that. So we're trying to get to those people. We've done a series of meetings around the country in the highest concentrations where those people are, and trying to get them to take advantage of the HARP refinance program.
Thank you.
The time of the gentleman has expired. The chair now recognizes the gentleman from South Carolina, Mr. Mulvaney.
Thank you, Mr. Chairman. Mr. Watt, thank you for coming back. I also appreciate your dedication to following the law and following the statutes. I hope it's an example you can set for the rest of the administration. Regarding the statutes, I think we've talked a little bit about today about the statute regarding the suspension. What statute did you rely on in ending the suspensions?
The Housing Trust Fund statute, the Affordable Housing Allocations, that's in HERA. It was reauthorized by Congress in HERA.
Correct. Oh, okay. I misunderstood what you're saying. But that's the statute that says when to suspend, correct? There is no statutory guidance for you on how to end a suspension, is there?
It says the director shall temporarily suspend. I would assume that the word temporarily has an inverse that says you can unsuspend. I don't, you know, technically you may be right that there's no statute that specifically says
let's walk through it then.
You do this if you unsuspend, but you apply the same criteria to suspend and unsuspend, and that's what we did.
I think that's fair, but by the same token, the mandate to suspend is not, there's no discretion there. You shall suspend if you find one of these three conditions, correct?
Yeah, and I interpret it the same way. You shall unsuspend if you find that these three things don't apply anymore.
These things don't apply. Then let's walk through them. It says that they contribute to the financial instability of the enterprise, would cause the enterprise to be classified as undercapitalized or preventing them from doing their capital restoration plan. But I heard you say something to Mr. Duffy earlier that was new, which is a reference to the Fannie and Freddie making a profit. That's not in the statute, right? That's not one of the factors you can consider in making a decision to suspend or end a suspension, is it?
Well, number one says are contributing or would contribute to the financial instability of the enterprises. If you are evaluating the financial stability or instability of the enterprises,
is Fannie stable?
The primary factor you're looking at is whether they're making money or not. Right?
Really? So whether a bank is making money is the only issue we look at as to whether or not they are stable. Is that what you're saying? If Bank of America is making a profit, then therefore they must be stable?
I don't make decisions about Bank of America. I'm following the statute that was written that applies to the
and I'm trying to press you on that.
Federal Housing Finance Agency.
Is Fannie stable?
We think it is, and we built into the decision to reverse the suspension prudent, reasonable safeguards in the event that they go back in the other direction.
I appreciate that, and I read that in the letter. It says if we ever have to go back to the Treasury, we'll suspend the payments. I get that. Not in the statute, is it? The protection you supposedly put in the letter is not part of the statutory consideration. I hear what you're saying, Mr. Watt, and I think it's a good idea, but it's not statutory. You can't take the position you're following the statute and then go, well, really what we're considering is profitability, and don't worry because we put something in the letter that says if we ever have to go back to Treasury, we'll stop the suspension. You're rewriting the law, aren't you?
Well, I'm following the conservatorship statute there, Representative Mulvaney.
Come with me then to number two regarding the undercapitalized, because I think you've taken the position several times that your agreement with the Treasury moots this section. Is that fair?
Yes.
My understanding, and again I'm new to this, is that your agreement with Treasury is an agreement, right?
That's correct.
How does an agreement trump the law?
Well, I think the law got trumped when they went into conservatorship and the taxpayers had to ante up $187 billion, and they had, and so an agreement was made. That was before I got there. I didn't negotiate the agreement.
But you would agree with me
that the agreement was in place when I became the director of this agency.
Typically, an agreement between one agency and another department of government cannot trump the law. You can't get around the law.
I absolutely agree with that. Right.
So if the conservatorship statute doesn't explicitly repeal Section B2, then Section B2 is still valid law.
I don't agree with that, but I mean, I understand what you're saying.
Why don't
I just
you agree
disagree
with
you.
If the conservatorship statute doesn't speak to B2, why is B2 still not good law?
Well, it just doesn't apply. I don't. I'm not sure. We're engaging in a legal argument here that.
That's what we're supposed to do, though, isn't it?
If you all didn't want to fund the Housing Trust Fund, you have the authority to stop the funding of the Housing Trust Fund.
And we exercise
But don't
that
expect
authority,
me to disregard the law and do it for you. If you want to do that, I mean, that's
I would
within
suggest to you, Mr.
congressional
Watt, we did
authority
just
to
that.
do.
We said, look, under these certain circumstances, we don't think we should be funding the trust fund, and all we're asking you to do is follow the law. And if you believe that it is undercapitalized or you believe it's unstable, then you should stop the payments. I yield back.
Gentleman yields back. The chair now recognizes the gentleman from California, Mr. Sherman, for 5 minutes.
Mr. Chairman, do you think we could take a 2-minute break?
The chair declares a 5-minute recess.
Hey.
So Mr. Green asked a question about credit that I used to
Yeah. Yeah. I think he's, I'm gonna tell you, you gotta bring your lunch. You're gonna start to mess with Bill Watt. Bill Watt's a very smart person.
Mr. Ambassador, have I ever seen you without your tux and bow tie? Hey, Mr. Ambassador, you an incognito. He's going incognito.
Turn your mic off.
You
heard all that?
Leverage against. So, yeah, that's okay.
On the 97s, right now, Fannie and Freddie cannot purchase the same types of loans that they used to purchase because of Dodd-Frank. They can't purchase the IRA, they can't purchase the products, all of the bad things.
If I need you, I'll tell you. Everything all right? Good, good. Thank you.
Oh, you're on the RS.
Committee will come to order. Members will please take their seat. Chair now recognizes the gentleman from California, Mr. Sherman, for 5 minutes.
Mel, welcome back. The only thing that would be better than seeing you at a distance would be having you close at hand, but I've taken your advice on so many issues involving financial services. I'm sure to get some more. I look forward to your input over the next 5 minutes. Good move on the Housing Trust Fund. I want to commend our colleague, Mr. Ellison, for organizing a letter, and unless he objects, I'd like to put that in the record of these hearings. So I request unanimous consent to put this fine letter in the hearings.
Without objection.
And to commend Mr. Watt for his actions. First, a kind of a technical question. The HUD 1 is being phased out by the new Integrated Mortgage Disclosure Form that combines the TILA or TILA RESPA forms and is intended to give consumers a better understanding of all itemized line item costs of the home closing. I wonder if you're focused on this rule and what steps, if any, HFA has taken on this rule to make sure consumers are fully informed.
I believe that is under the Consumer Financial Protection Bureau's jurisdiction. We haven't been actively involved in it. I do meet regularly with the director of the Consumer Financial Protection Bureau to make sure that that we are not at odds, and we are all also members of the FSOC committee together, which allows us to exchange ideas at that level. But we're not directly involved in that.
I'm sure that you're focused more on real estate lending than some of the more general folks involved, and they'd benefit from your input. Your predecessor pushed for a lower conforming loan limit. You demonstrated your wisdom in going in a different direction, an action that has done more than anything else to impress me with your wisdom. Do you see that ugly proposal rearing its head again anytime soon?
It has to, because statutorily it has to be reviewed regularly, and so we are almost constantly in the process of reviewing conforming loan limits, and so yes, it will raise its head again.
I look forward to continued wisdom on your part, and I yield back.
Gentleman yields back. The chair now recognizes the gentleman from New Mexico, Mr. Pierce, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Director. I know that we haven't always agreed, but I've always admired your plain language, your straightforward responses, and find myself admiring that today. So as we look back to the problems that put you into conservatorship, we've found that Fannie began and everyone began to expand the number of loans that were given to people that probably shouldn't have gotten them. And the OIG in 2012 found that FHFA was somehow somewhat responsible because they overlooked the fact that Fannie was beginning to relax its underwriting guidelines. They were beginning to buy loans that they said they wouldn't buy. And they didn't accomplish that with a change in law. They accomplished it with variances. And so I guess my question is, what are you all doing to see that the agency doesn't go around the rules again? But they were being pushed not by the White House. And so you said before you're independent from the White House. I just wonder if you're independent from us, because as members of this Congress and this body who are pushing for those relaxing of those standards so that people could get loans. And I hear some of the same language today. So what are we doing to make sure this doesn't occur again?
Well, first of all, at that point, Fannie and Freddie were not in conservatorship, and so the regulatory role was a lot looser than the conservatorship role that we are playing now. We're involved in virtually every decision that Fannie and Freddie makes, we take very seriously our statutory mandate, both to do things safely and soundly, and to do things in a way that will provide liquidity in the housing finance market. And that's why I said in my opening statement, we are constantly walking that balance. We would be as responsible for those decisions now as Fannie and Freddie would be, because they are in conservatorship and as part of our conservatorship.
I understand, but someday they'll be out of conservatorship, and so I again wonder about the oversight mechanism that will take a look at what they're doing, because it was them that facilitated. If Fannie had not bought those mortgages that were never going to pay off, and people knew they would never pay off, but they didn't care because they were able to get rid of them out of the banks and send them on to someone else and let them worry about it. And so as we go through into the future, I worry that the same thing. I wonder also, so Fannie and Freddie are making a profit, and so I guess you were talking about the models that you all have done. Have you got models that tell you at what rate of growth that we're going to start experiencing troubles, and should we increase our surveillance? What rate of growth would that be?
Well, we don't do it at what rate of growth.
Whatever you have.
We do it on a loan-by-loan basis, and we set prudential standards that apply to loans, so we make sure we never get to determining where you fall off that cliff or don't fall off that cliff. Yeah, we're nowhere close to
having run a business
to the level of risk that was being assumed.
Reclaim my time. Having run a business with 50 employees, I find it beyond imagination that you can take $1 trillion portfolio and look loan by loan, with all respect. I mean, I appreciate your saying it, but I find that really hard to believe. And
I apologize. That probably was an overstatement.
Okay.
But we set prudential standards that have to apply.
But those standards
loan by loan
before.
by loan. Yes.
Those standards existed before, and under the table or wherever, the people who were getting tremendous bonuses at that period of time began to cheat the system. They began to rig it to where they could get bigger bonuses, and so until you reevaluate human nature. The last point I think I want to make is that another great pressure in the system was the low interest rates. And so at some point the Federal Reserve, whether they like it or not, is going to have to go up on interest rates. That's going to put more pressure into the housing market, and I see that if we don't have our ship really right when it goes into the troubled waters of lower growth rates, higher interest rates, that we're going to have exactly the same thing, the same problems with an agency that is way undercapitalized. I mean, you have to admit that they're in shaky financial shape as we move forward and if we get into troubled waters. With that, I'd yield back my time, Mr. Chairman.
Gentleman yield back. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, ranking member of the Monetary Policy Subcommittee.
Thank you so much, Mr. Chairman and ranking member. And it is so good to see the Honorable Director Watt here with us. He is here in really good form, just the facts, and really it's a relief to have you around and that you haven't just rode off into the sunset. I would like to start out by just sort of making a comment before I engage the director in a question, because much has been said today about the creditworthiness of borrowers with the 3% down, and there has been much intimation that lower income borrowers were the cause of the financial crisis in 2008. And so I just would like, Mr. Chairman, to ask unanimous consent to put into the record a report done by Manuel Adelino from Duke University, Antoinette Showar from MIT.
Without objection.
Thank you. And Felipe from Dartmouth, and also a seminar participants from Harvard Business School and MIT.
I'm sorry, if the gentlelady will suspend, we seem to have a little audio problem here with the gentlelady's microphone. And maybe you ought to hit it once or twice. Try again.
Thank you. This is a 42-page report, Mr. Director and Mr. Chairman, but its conclusions are that the higher default rates can be attributed to loans made to middle and upper income folk and not low income folk. And so I just wanted to clarify for the 1,000,000th time that the lower income borrowers were not the primary reason for the financial meltdown. I don't know if you have any comment about that research, but I would like to enter that into the record.
I'm glad I don't have to participate in that debate anymore.
Okay. Thank you. I was looking through your prepared testimony, and you talked about mortgage servicing. And I guess it wasn't really clear to me through your testimony what was the product of the, there hasn't been changes in the compensation structure, better aligning of servicers' incentives with those of the enterprises, and I was wondering how that translated into better mortgage servicing for the customers.
Well, that's a very difficult subject because it's massive. What essentially has happened over time as a result of the meltdown is servicing went from just collecting money on mortgages to a much more difficult process of dealing with people who were in default. And so that whole industry has evolved, and most of it was done originally by lenders themselves in-house, and much of it now has gone to outside people who specialize in servicing, and that has created a set of issues that we've had to deal with because some of them, even though they might have been better servicers, were not necessarily as financially sound for the long term. So we've had to deal with that. There's a wonderful study that was just put out by the Urban Institute that talks about that evolution and the costs that have been associated with servicing, that where you could service a loan for like 50 cents a loan, and now it's up or $50 fee to a servicer. Now it's up to well over $2,000 as a result of the increased responsibilities. But it's a very difficult area, and we internally at FHFA have had difficulty because this whole meltdown has put stresses on the servicing industry. I made a speech over at Brookings where I said it was easy to service when all you had to do was collect money. It is very difficult servicing mortgage now when people are in.
Reclaiming my time, I would assume that well, I have another question.
The gentlelady may have another question. She's just simply out of time, so she could submit the question for the record, and the witness can respond as possible. Time of the gentlelady has expired. The chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman. Mr. Watt, good to see my friend from Charlotte.
Good to see you.
You seem to be relishing your new job, and we wish you well.
Thank you.
Frankly, we want you to be successful. And as noted by our comments today, we share or have the concern that of what would come out of the current policies of easy credit that we believe was complicit in the housing crisis that we have just previously experienced. Mel, as you know, former Acting Director DeMarco, he proposed these increases for the guaranteed fees that GSEs would charge the lenders. And under your leadership, you've suspended the implementation of those increases. This last December, the CBO made a public statement, a report, that suggested how we should attract new capital into the secondary mortgages. And I could quote them. They stated, policymakers should continue to increase the two GSEs guarantee fees to attract new private capital to the secondary market, and that even a small increase in guaranteed fees from the present level will allow private firms to immediately compete for the highest quality loans. You've also stated that you want to find ways to bring additional private capital into the system in order to reduce taxpayer risk. Now, through your own decision, you've chosen to go against the former director, and you've chosen against the thinking of the CBO. If you are not willing to increase the guaranteed fees, what additional steps would you recommend to increase the role of private capital and to decrease the role and exposure of Fannie and Freddie and frankly, the American taxpayer?
Let me just put in perspective one thing. I've never done anything in opposition to the former acting director. I have the greatest amount of respect for Acting Director DeMarco
contrary to his
and the decisions. Yeah, so I just want to be on record as making that clear. And I've taken some abuse for that, for saying that, but I just sure. Have to say it. The primary means that we are using is to test different risk-sharing models. And they've been very successful. We have tripled, quadrupled the amount of risk-sharing we've done in the 1 year that I've been there. The enterprise has had a goal of $30 billion in 2013. We increased it in the scorecard to $90 billion and shot right past it before the third quarter was over of 2014. We've increased it again in the 2015 scorecard. We're encouraging them to look at different risk-sharing alternative models to do it, not just the ones that have already proven successful. We've encouraged them to look at whether it is practical to even go back and risk-share some of the legacy book of loans. All of this risk-sharing we've done essentially has been with new loans, the more pristine loans. So we are very active in that space. We are also looking at the G-fee question. The conclusion that you reached that we are not going to change or are going to change, I think is premature. We just don't know yet whether we're going to change it or not, and we're taking into account the study that was done, our own study, the input that we got to a series of very cogent questions about how G-fees should be set, what factors should be considered in setting guarantee fees. And when we come out with our report, hopefully by the end of this quarter, I think we'll add a lot of information. In fact, even in the request for input, we put a lot of information out there that people had never known about how G fees were set.
Quickly, may I ask, you have suggested, or you've stated one of your policy changes is that you would allow these down payments to be as little as 3%. And you stated, well, there's other offsetting measures that you would implement. Would you give more clarity to what those are?
Homeownership.
Given that we believe that easy credit, as we saw the chart earlier, was a major factor in the current demise.
Very brief answer, please.
Homeownership counseling, mortgage insurance, private mortgage insurance, higher FICO scores. I mean, there are a number of factors that we are taking into account that would offset the lower down payment.
The time of the gentleman has expired. The chair now recognizes the gentleman from Minnesota, Mr. Ellison.
Thank you, Mr. Chairman and Ranking Member. My colleague Brad Sherman beat me to it by putting the letter that we sent you into the record, but I just wanted to say that I was glad to see that we had 61 members of Congress, including every half of this committee, almost half of this committee, agree that your action to end the temporary suspension of contributions to Fannie and Freddie to the Housing Trust Fund was the right thing to do. And so very happy about it, and it's already in the record, so I don't need to enter it in, but I just want to make note of that. And I also want to comment, too, that it's true that you have to face a lot of questions from folks who believe that the real problem of the crisis of 2008 was GSEs and borrowers. But it's also true that you have to contend with people who think that you ought to be moving faster in the other direction. And I know that because I've had constituents of mine say, well, why doesn't Director Watt do this and do that and move quicker, things like that. I think one of the other things that your office has done after taking a lot of care, a lot of time, a lot of research, is decided to review the process of the arm's length transaction and not doing any arm's length transactions and reviewing that policy. I wonder if could you talk about some of the thinking that you entertained as you were reviewing that policy and why it is that you came out the way that you did?
Well, there was a concern that if you allowed a borrower to default and then turn around and buy a piece of property at a lower rate, that you would be incentivizing that kind of negative behavior. And that had kind of taken hold and was wagging the dog. I mean, there probably are 1%, 2%, 3% of the people in the world who could think that far ahead that they would default on the loan and then after foreclosure go back and buy it at a lower price and come out better. But we thought the moral hazard, which is what people were calling that, we could minimize that by putting some prudential factors around that decision. And so that's what we did. It's not automatic that somebody can do that, go back and buy the home back for a lower price. And we put a time period on it so that we could test it going forward to make sure that we didn't do something that was irresponsible. But it was a slow, evaluative research process, as every one of these things. You kind of put your finger on something. What I found in this position is that there's nothing generally as simple as I thought it was, right? All of these decisions are very difficult and require good research, and that's what we try to bring to every decision.
Yeah, I just want to also say that you've been available to talk to everybody who wants to talk to you. You've met with ordinary homeowners. You've met with policymakers. You've done an exhaustive thing, and I want to commend your staff. Actually, you got a pretty good staff member, Carrie Johnson. She used to work in my office, and she's gone on to bigger and better things, but I'm glad she's landed in the right place over there. So could you just talk about why you think it's so important to do all the outreach you've done and consult everybody you've consulted and do all this research you've done?
Well, I think one of the members over here pointed out that he appreciated plain talk. There's a lot of misinformation in this territory, and I think the more you can kind of break things down and explain them in terms that borrowers can understand, that the public can understand, demystify this whole process, the better off we are. But most of the outreach we have done and going out has been about specific things that would benefit borrowers, such as the HARP program or the Neighborhood Stabilization Initiative in Detroit. I've kept a very, very low profile. I have no interest in being in front of a camera.
Too late.
The gentleman's time has expired.
We've got a different approach to it now.
You look
Thank
good
you, sir.
Look good on camera, Mr. Watt. The chair recognizes for 5 minutes Mr. Rothfuss from Pennsylvania.
Thank you, Mr. Chairman. Is this on? Can you hear me? That's good. Director Watt, welcome back to the committee for a couple hours anyway. I want to talk a little bit about the 3% down payment program. Fannie Mae, in its 10Q that it filed with the SEC in their third quarter of 2014, mentioned the program. And here's what they said. We also plan to offer a 97% LTV ratio product to all customers in 2015. To the extent we are able to encourage lenders to increase access to mortgage credit, we may acquire a greater number of single-family loans with higher risk characteristics than we have acquired in recent periods. However, we believe our single-family acquisitions will continue to have a strong overall credit risk profile given our current underwriting and eligibility standards and product design. So it seems to me that Fannie Mae, in its filing with the Securities and Exchange Commission, has admitted that the program is going to result in loans with a higher risk. Would you agree with that assessment from Fannie Mae?
I've admitted that today, too, that possibility exists if you're not careful, which is exactly why we're being careful. And that was a third quarter analysis, and you notice they didn't announce this until December because we were putting all of these constraints around them to make sure that we minimized that risk.
So
right?
If I looked at when they file a 10Q for the quarter we're in right now, I would not expect to see something like that?
You may see something similar to that, yeah, because, 10Qs, as you know, are designed to give the public and people out there the worst possible case that you could
an awareness
present
of
to
the
them.
risks.
That's right.
The administration in 2011 released its so-called white paper entitled Reforming America's Housing Finance Market. On page 14 of that document, the administration recommends that 1, the FHA market share should be reduced, 2, FHA should return to its pre-crisis role as a targeted provider of mortgage credit access for low and moderate income Americans, and 3, FHA mortgage insurance should be increased. Moreover, the administration recommends that a coordination between Fannie, Freddie, and FHA to help ensure the private market, not FHA, fills the market opportunities created by reform. Do you believe the recent policy announcement by HUD, effective yesterday, to lower FHA annual mortgage insurance premiums by 50 basis points will affect the return of private capital to the markets?
I don't have an opinion on that, Representative, because HUD is not under, FHA is not under my jurisdiction, and HUD is a part of the administration. We're an independent regulatory body.
How many new homeowners had you anticipated with the 97% LTV program?
I'm sorry?
How many new homeowners have you anticipated with the 97% LTV program?
It is a very, very small percentage of the overall portfolio will be a very small, we anticipate that it will be a very small percentage of the portfolio of both Fannie and Freddie. And we have those numbers. I'm not sure I can access them quick enough to give them to you.
We'll follow up with you on that.
We'll be happy to provide them to you.
You know, when we talk about the 3% down payment, you've been talking a little bit about the credit worthiness of people paying back their mortgage and they're able to pay it back. But we do have an issue out there with people who are underwater. And one of the concerns I have is when you have institutions such as Fannie and Freddie and the scale that they're able to influence the market, coming up with a program like this. I read an article just this weekend, and you may have seen it in the Washington Post, about a family in Prince George's County where they have a $560,000 mortgage, but the home is worth $480,000. And while that family may continue to pay on that mortgage, there's really another issue here. And it's families who do not feel as though they're getting ahead, and families who may feel trapped in their house. And when we have a program that has the chance to encourage this, we saw a significant increase in mortgages that were underwater following the crisis. I mean, what would you say to a family like that who buys into a program?
They're in a very difficult situation, and I've been in rooms with them and had discussions with them, and all you can do is tell them you regret that they're in a situation, and we're trying to make sure that future borrowers don't get themselves in that same situation.
The gentleman's time has expired. The chair now recognizes for 5 minutes the gentleman from Delaware, Mr. Carney. Do you want to maybe try the one next to you, Mr. Carney?
Brother, right here.
There we go. We got a live one.
Me or the mic?
Both of you.
I hope this doesn't mean I have to sound as smart as Mr. Foster. Mr. Chairman, Ranking Member Waters, thank you for the opportunity to ask a few questions. Mr. Director, welcome back to the committee. We certainly miss your common sense and straight talk here, and personally I miss your North Carolina drawl over my right shoulder most of the time during the hearings. You have said several times that you're not going to comment on the specifics of GSE reform, that's a legislative responsibility, but you have made some public comments on whether it's necessary or not. Could you comment for us now about the sustainability of the current situation, what we should be concerned about, and your thoughts on that without going into any specifics about what we should do?
Well, there's nothing worse I've found in this area of the market than uncertainty, and the longer this drags out, the more uncertainty there is. So you have that risk and imperative for Congress to do something. And that's not about what they do, it's about providing more certainty. We have challenges at Fannie and Freddie maintaining an employee base in this environment because they don't know what the future of Fannie and Freddie is. So there are multiple implications that follow from the failure to do GSE reform.
So would you say it should be a high priority for us, for the the Congress and the administration to get that done? I mean, when I first came here, the former chairman was criticizing the administration for not doing anything on GSE reform. The former ranking member, Mr. Frank, was criticizing the Republicans for not doing anything on GSE reform. Now, there have been a lot of proposals. I'm part of a team with Mr. Himes and Mr. Delaney that have come up with a proposal that I'd like to talk to you about. But do you think it's time for that to get done?
Well, I would say there are implications for not doing it. For me to put a priority on it,
fair enough,
I think is an inappropriate role for me, because there are a lot of things that Congress deals with that are priorities,
Sure.
and that's just not my role to set those.
So one of the things that our legislation does is require private capital to be in a first loss position over an explicit federal guarantee. In some ways similar to the white paper that Treasury presented here in this chamber when you were a member of the panel 4 years ago. You've done some of that in terms of, my question is, what is the appetite for private capital to enter into this space, and do you have any sense as to what that premium might be for that first loss position?
Well, private capital, there is an appetite. I mean, I don't know that I can assess the magnitude of the appetite, but I mean, I think they're playing an important role in the availability of housing finance in this country, private capital that is, and we're trying to facilitate that role by taking loans off of their books so that they can make more loans. That was the whole philosophy under which Fannie and Freddie were founded in the first place. So, and we're facilitating it through transferring risk back to the private sector. So, but that still does not negate the importance of providing certainty in the future by doing GSE reform.
Well, thank you. A number of, as I said, are working on that, and we've had discussions with members of the Senate, with Democrats and Republicans on this committee, and hopefully there will be an opportunity in this Congress to move something forward that basically contains a federal guarantee to, I happen to believe, the question was asked you earlier about the importance of a 30-year fixed mortgage, and you had some observations about that. I happen to believe it's important from an affordability perspective, and the only way to sustain that is through some government guarantee. Let me just close by thanking you. I was one of the members who signed Congressman Ellison's letter requesting that you end the suspension of the fee to fund those two, the Housing Trust Fund and the Capital Market Fund. And we appreciate your decision to do that. And good luck to you.
Thank you.
The gentleman's time has expired. The chair now recognizes the gentleman from Arizona, Mr. Schweikert, for 5 minutes.
Thank you, Mr. Chairman. Is it Chairman Duffy now? Director Watt, actually, earlier you said something I truly appreciated, and I wish everyone had sort of embraced, that your current position is substantially risk management. And I'm not sure a lot of folks appreciate that that really is the core of your job at this moment. But I have a handful of things I wanted to run through, and there's never enough time for all the questions. First one, you had an interesting discussion about servicing. I accept that a lot of the servicing can be actually fairly complicated, but a couple mechanics. For a low-cost servicer, great. The ability to transfer impaired paper that may need some additional love and touches to a specialty servicer that deals with impairment issues. How is that harmonization of servicing standards that I believe your folks have been working on? Do you know where progress is?
We're making progress. You know, we encountered a different set of circumstances after the meltdown. We went from a situation where lenders were primarily doing their own servicing to a situation where they wanted to get out of the servicing business because it was either too complicated or because they had to have higher capital requirements if they stayed in it, various and sundry reasons. And so a lot of the servicing rights got transferred, and that imposed upon FHFA and Fannie and Freddie the responsibility to look closer at not only the ability to service a loan, but what are the longer-term implications of that? Are you capitalized well enough to be in this business for the long haul if things go south?
Well, and my great hope, and I know it's complicated and a lot of folks don't appreciate that, is as you work on that harmonization,
we are definitely doing that.
paper or loan that has some difficulties to be able to be moved easily, efficiently, low-cost-wise to servicers that will actually do that, reach out to both protect the securitization over here, but also to work with those homeowners. Second,
can I just make a point? You'd be, I think you would be happy with the most recent set of things we've been working on in that area to try to encourage loans to servicers, transfer of loans to servicers who have a history in working well with borrowers,
as you know,
and staying out of foreclosure as opposed to going to foreclosure.
Only obligation there on your side is a simple, efficient, low-cost ability to move paper back and forth when necessary. Second one, and this is more just from a being from the West, and I know you said you're working on it. You're working on sort of the risk pricing models, and you saw it pop up. For those of us out in the West, we're deed of trust states. We're very efficient. We're very low cost in the ability to do sometimes what's difficult. Some states are mortgage states that have put on lots and lots of consumer protections, but have raised the costs. And it is only appropriate, only fair, that those different cost structures be priced into the product. Because for those of us, particularly out West, we often feel like in our pricing, if you have universal national pricing on that risk, that we are subsidizing states that have made it much more difficult to move through that foreclosure process. So just something, it's there, and it's math. So hopefully you'll treat it that way. The thing I'm most interested in, and some of this I'm going to have to give you in writing because we'll never have time, was it last week you did the stacker deal?
Yes, well, we are regularly doing stacker
deals. But the
yeah.
most recent one, was it the first loss piece that was transferred out? Which is fascinating to me, because in that sort of model, you're actually creating a securitization where the GSE ultimately is a catastrophic coverage. Help me understand in the remaining seconds how that works, and in some ways, how that may help us drive towards GSE reform.
So when we started doing risk transfers, we started by having the GSEs, Fannie and Freddie, retain the first loss, transferring risk on some subsequent loss, and then coming back in with the GSEs retaining catastrophic loss. We are now experimenting and looking at the process of transferring the first loss position back to the product.
Director Watt, I'm going to probably have to in writing, and thank you for your patience.
Time has expired. The gentleman yields back. The chair now recognizes Mr. Kildee from Michigan for 5 minutes.
Thank you, Mr. Chairman. And at the risk of redundancy, Mel, it's good to have you back. I only got to serve a year with you, but as you can see, in the year that you've been gone, I've become the second ranking member on the Democratic side of the committee, at least for the moment. Before I ask some questions, but I would ask you to comment, I'd like to submit for the record some comments from the Homeownership Preservation Foundation regarding strengthening of the U.S. housing finance system through provision of housing counseling services. And we talked about credit score and down payment related risk mitigation factors. And as you have stated, there are other factors to be considered. We had a panel here some months ago, and I think it may have been after you left. You probably heard similar panels where we had a number of representatives from the mortgage industry talk to us about, in general, about mortgage lending and the risks associated with mortgage lending. And we happen to have an individual from an organization that does a lot of affordable housing work. And some of the lenders referenced that if they use the same process, which include a heavy emphasis on home ownership counseling, that they would have default rates that were lower. Could you quickly comment on that particular point? And, Mr. Chairman, if you don't mind, I'd like to have these comments entered into the record, and then I have a couple of other questions.
Without objection.
I don't think there's any question that somebody who gets good home ownership counseling, either pre-ownership or in some cases post-ownership, it makes them better borrowers. It can't be just any counseling. It has to be good home ownership counseling, but it really has an impact because especially first-time homeowners have little appreciation for the responsibilities that go with home ownership that are different than being a renter.
It's a really important point, and I hope that as we move forward on whatever process we engage in, that we make sure to consider those factors. I'd like to turn to another somewhat related question, and it has to do with access not just to credit, but access to mortgages, even for credit-worthy individuals in markets such as markets I represent. I represent Flint, Michigan, my hometown, where the average home price is $47,500. And for many legitimately, legitimate borrowers with, decent credit, for many banks, many mortgage lenders, mortgages of that size, they say, just don't make economic sense. And I wonder if there is anything that you are working on or could refer to us in terms of the work of FHFA that will make sure that in those markets we still have opportunity for home ownership, because otherwise we're basically consigning those communities to rent. And your point about the effect of vacant properties on surrounding values is an important one. But it's also the percentage of home ownership of those occupied properties that has a similar effect. And I wonder if you could comment on that.
So we put in the 2015 scorecard an obligation on the enterprises to work with community, smaller banks and state housing finance agencies to try to get to those lower and underserved areas, lower cost areas and underserved areas. And I think we are going to make some progress on that this year. I think the 97% loan product will have some bearing on that, although it's not specifically designed for that category of.
I would agree. In this question, we have I obviously listened as you answered questions about particularly related to down payment thresholds. I think we could all sort of agree, you don't even have to bother to answer the question, is if we decided that a 20% down payment standard would be enacted, that we would have a far lower default rate. Or if you had to have $1 million in net value, in net assets in your own personal portfolio, you might have a lower default rate. The question is, how do we balance these interests so that the maximum number of Americans have the opportunity to achieve home ownership, understanding that there are many, many ways to mitigate risk associated with people who are in a financial condition that does not allow them, because they're dealing with other exigencies in their life every day, to save the kind of money that it takes. One of the ways, and I would just, you may comment on this, you may not be able to because of the rulemaking process, but the membership standards question for a Federal Home Loan Bank is an area of some concern for me, because in some ways by limiting membership standards we might actually cut off another source of revenue that can be directed to help some of these local community-based organizations that are working on home ownership.
And the gentleman's time has expired. Maybe Mr. Watt could respond to Mr. Hildy in writing. The chair now recognizes Mr. Barr from Kentucky for 5 minutes.
Director Watt, welcome back to the committee. And
thank you.
Congratulations on your confirmation. As you know, the Consumer Financial Protection Bureau has finalized its ability to repay qualified mortgage rule, and the purpose of that rule is ostensibly to encourage safe and sound mortgage loans. But a recent survey of mortgage lenders showed that about 2/3 of respondents would restrict lending directly because of the qualified mortgage rule as defined by the regulators under Dodd-Frank. And about 80% of those respondents expected the new regulations to measurably reduce credit availability. Now, obviously, given your agency's, FHFA's, recent moves, recent policy changes, you appear to share the concern about credit availability and access to affordable mortgage credit. The changes to guarantee fees, the guidelines allowing GSEs to buy loans with ultra-low 3% down payments, and all of this appears to conflict with the Bureau's qualified mortgage rule. So my question is FHFA pursuing a policy of encouraging mortgage lenders to originate non-QM loans that the Bureau would deem risky?
No, we are not. We're not without prudent compensating factors to take whatever that increased risk might be into account.
Well, wouldn't it make sense that a borrower that can only afford 3% down is likely to run into the debt-to-income ratio limitations imposed by the QM rule?
Yes.
Okay. So I guess again, I'm just curious to understand how the American public is to interpret what the federal government is doing, sending mixed signals of encouraging more credit availability on the one hand, your policy changes versus what the Bureau appears to be doing, which is tightening or restricting access to mortgage credit.
I think a judgment has been made that because Fannie and Freddie are under conservatorship during the period that they're in conservatorship, we could make those judgments without being subject to the qualified mortgage rules for a period of time. Now,
if I may, I
don't know that will sustain itself forever, but that's where we are at this moment.
Director, I've introduced a legislation called the Portfolio Lending and Mortgage Access Act. I'm going to be reintroducing that legislation. It's got some bipartisan interest in it. It's motivated by the same concern that you have about access to mortgage credit for responsible borrowers. And the idea would be to modify the QM rule to allow lenders to retain the risk, which was a primary motivating policy in the Dodd-Frank law, retain the risk, portfolio those loans to get the same safe harbor that other QM loans would get. And my question is, wouldn't that be a more sensible approach to dealing with these 3% loans so that the risk is on the shareholders of the bank and not on the taxpayer?
Well, I think that's a judgment for Congress to make. It wouldn't be a judgment for me to make. If you've introduced the legislation, then I'm sure Congress will evaluate it.
Well, thank you. Let me just quickly follow up on some of the questions that Congressman Duffy was asking you about the Housing Trust Fund. With roughly $3.3 trillion in assets and $9.5 billion in capital, Fannie Mae is currently leveraged at 341 to 1 and features a leverage capital ratio of 0.29%. Freddie Mac has roughly $2 trillion in assets and has a leverage capital ratio of 0.64%. The typical bank, I understand, to be leveraged about 10 to 1. So the current amount of leverage at Fannie and Freddie is far, far greater than the typical financial institution. I heard your testimony to be earlier that you believe that Fannie and Freddie are adequately capitalized and you're just following the statute. Is that right? Given those capital ratios, is that true?
I don't think I expressed any opinion about the adequacy of the capital. What I said was that we are operating under a preferred stock purchase agreement that has basically taken capital out of the equation during the period of the conservatorship.
Well, my time has expired, but I would suggest that if they are adequately capitalized, I would wonder why they're still in conservatorship.
The gentleman's time has expired.
Chairman Duffy, could I trouble you all for another 2-minute break?
No objection. The chair will recess for 5 minutes again, for a second time. The committee now reconvenes. The chair recognizes the gentlelady from Ohio, Ms. Beatty, for 5 minutes.
Thank you so much, Mr. Chairman. Let me just say to Director Watt what a pleasure it is for me to be here. I noticed you looked at me when you saw this big book and list of questions. Well, in full disclosure, Director Watt was my mentor. And I recall him always saying to me, read everything and always have good questions. With that said, let me just say on a very serious note how much I appreciate the work that you and your team, that you are doing to protect all of my constituents and constituents across the country with housing and those regulations. But today I'd like to lend my voice to one of the questions that we've heard from both sides that centered around membership into the Federal Home Loan Bank related to the September FA issued ruling revising the membership requirement of FHLBs. Well, of those 1,300 and some comments that you received, my district was not silent there. So on behalf of my district, the Ohio Capital Finance Corporation, which serves thousands of households, raised concerns expressed by other community development financial institutions. They hold dearly the affordable housing program is one of the most important sources of funding nonprofit housing communities. So the question is regarding the requirement to meet 1-in-2 ratio test of mortgages to total assets. And what they want to know is, since they don't hold mortgages, they being the Ohio Capital Fund, that range from 1 to 10% depends on the type or the asset size. That when that goes into effect, it would cause them to terminate their membership with a Federal Home Loan Bank in Cincinnati because it doesn't hold mortgages. So would you or your team give any consideration of doing an evaluation on the impact of the burden to community development financial institutions of a less severe remedy than loss of membership?
We are looking at every aspect of this. We've got, as I indicated before, approximately 1,300 comments in response to the proposed rule, and we're going through them. Our preliminary analysis indicates that despite the fact that there are 7,500 members of the Federal Home Loan Bank system now, only 50 to 100 of them would be adversely affected by the rule. And that's not to minimize the value of that 50 to 100, but that's definitely one of the factors that we will take into account.
Okay, thank you for that. Mr. Chairman, may I ask unanimous consent to have the letter from the Ohio Capital Finance Corp. Entered into the record?
Without objection.
Thank you. The second question I have goes to Amway. I am very honored that Ranking Member Maxine Waters asked me to be involved and to chair that committee. You certainly know through your organization, having Amway prior to Dodd-Frank, that there are different regulations. With Dodd-Frank, they now have the whole issue of transparency, reporting back to the public on the numbers. Diversity is very important to me for a whole host of reasons, but can you briefly share with us what you're doing since you came under the Recovery Act of how you are being transparent and sharing the diversity through Amway?
Well, there are statutory reporting requirements, and we obviously are complying with those. But more importantly, what we've done is tried to take a look at how to make the Amway office an important ingredient of our organization, not just keeping numbers, but embed them in decisions that are being made. And in the selection of our director of the Amway office, we found somebody who had transactional background, not just OMWI background, so that we could get that person involved in the kinds of decision making that would have some impact on diversity.
Thank you.
The gentleman's time has expired. The chair now, yes.
Unanimous consent to enter into the record an article that ran in the Washington Post on the disparity in wealth between blacks and whites.
Without objection.
Thank you.
The chair now recognizes Mr. Tipton from Colorado for 5 minutes.
Thank you, Mr. Chairman. And Director, thank you for taking the time to be able to be here. I'd like to follow up actually on a comment that Ms. Beatty was just making in regards to our federal home loan banks. You made a comment earlier in our conversation here to my colleague from Oklahoma, Mr. Lucas, that we were following statute in regards to establishing some new rules in regards to membership in the federal home loan banks. And I'd like to follow up with you on that, and that looking in through the Bank Act, it does not address a minimum level of mortgage loans. That is not cited. And I guess my concern over this issue is Ms. Beatty and I think Mr. Lucas both spoke to these issues. My particular state of Colorado, we have over 200 community banks, credit unions, insurance companies. They're members of the Federal Home Loan Bank. And these financial institutions, they do responsibly utilize the liquidity that is provided in order to be able to deploy credit out in support of housing finance, agricultural production, small business formation, community development. And they do this currently in full compliance with the Federal Home Loan Bank Act and the congressional intent, as I read it, and through the existing programs. Under this proposed rule issued on September 12th, has the potential to be able to decrease federal home loan banking system membership. And have you quantified the potential impact that that may have on rural America right now? Because while we may have pockets of prosperity in the country, rural America is not feeling it.
As I said in response to Representative Beatty, our preliminary analysis indicates that only 50 to 100 of the 7,500 members would be adversely affected by either the 1% requirement or the 10% requirement. There is a statutory requirement. The question is whether it will be applied only when a member becomes a member of the bank, or whether it will be applied on an ongoing basis. That's really what the rule addresses. The statute clearly says that you'll have 1% of assets in home mortgage loans. That has been in the past applied only at the time of becoming a member, not on a continuing basis, right? So we're looking at whether that undermines the purpose of not to require it on an ongoing basis, not just a one-time basis, right?
Right. And what I would like to be able to, I guess, express is often in Washington, a smaller amount is often trivialized. In some of the small communities that I represent, I have 54,000 square miles of Colorado. If one of those banks happened to be in that 50 to 100 that would then be shut down, it'd be a reasonable assumption, obviously, that we weren't going to be able to extend credit in that local community because it's going to be a small community.
We'll certainly take that. We will certainly take that into account.
That's going to be critically important, I think, for us because our communities truly are struggling under those what we feel are over-regulation coming in out of the federal government. So thank you on that, and with that I yield back, Mr. Chairman.
Do you want to yield to the chair? Mr. Watt, just want to follow up on some questions I had for you for the next minute. Is it fair to say that the G fee is based on risk? It's risk-based, right? The G fee is risk-based.
An element of it is risk-based. The question is, what will the G fee be designed to cover? Microphone. Will it be only risk? Will it be accumulation of capital? Will it be attracting?
So today, is it?
But one element is definitely risk.
So you're charging more than the risk for the G fee? Because some would argue that in our assessment, if you have a credit score of 740 and you put 40% down, you might be paying a little more per your risk. And if your credit score is 650 and you only put 3% down, you get a little subsidy based on the risk of the G fee. And this is actually from your data.
Well,
do you disagree with your data?
No, I'm not arguing with the data. I'm trying to put it in a frame here that
and I'm going to have to gavel myself down in a second. So I guess maybe you could think about this, and maybe we'll have a chance to come back to it. Are you charging more in the G fee than the actual risk, or are you undercharging for the risk, or are you hitting it just right?
Well, one of the things that a lot of people on this committee have been advocating is that we charge more than risk, so that we can attract private capital. So, I mean, you kind of meet yourself in these arguments going and coming.
I don't want to abuse the gavel. Maybe we can come back to it later. The chair now recognizes the gentleman from Texas, Mr. Williams, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Director, for being here today. We've covered a lot of ground. Appreciate your service. I'm a private sector guy, own businesses in Texas, and I'm one of those that believes the private sector is the answer, not the federal government, to a lot of the issues we have. I do want to say one thing. You had mentioned earlier that you had hard time with your employees with Fannie Mae and Freddie Mac because of the fact they were unsure of what their future might be. I heard you say that. Mm-hmm. And I would just say welcome to the private sector. That's the private sector is going through that every single day, wondering what their future is as small business owners, moms and dads, and so forth. So that feeling is not alone with your group of folks. It's all over our country because of government regulations. My first question would be this. What is the Treasury doing with the money they get from the GSEs every quarter? If the Treasury spends the money now they get from Fannie Mae and Freddie, won't they have to borrow more or tax more to raise the money in the future to meet the normal losses that could be coming in?
I can't answer that, Representative Williams, because I'm not at Treasury. We sweep the money to Treasury. It gets applied to the deficit. It gets applied to government operations. I don't, I guess the argument is, should it be doing that, or should it be building up a reserve or capital reserve of some kind? And that's just, but that's not a decision that I can make.
I think the concern is we've got such a big deficit and it's going in the hands of the federal government. Where's it going? Also, just to kind of help me understand a little bit, like I say, we've covered a lot of ground today. What's the average credit score to a 3% customer?
I don't know that I can tell you that off the top of my head, Representative Williams.
Okay. And we may have covered. I heard a figure earlier, 2%. But what's the foreclosure rate in your portfolio, percent to the total? I heard a figure. I thought of 2%. Would that be right?
I can tell you that. If you'll let me get to.
And while you're looking at that, when do you decide to foreclose? I mean, how far behind payment, how far past due are homeowners before you say we need to foreclose on this piece of property?
Well, there's no fixed answer to that. I mean, we get concerned if somebody gets 30 days behind payment. We get more concerned if they get 60 days. We get more concerned, at what point you quit working with a borrower to try to get them back current, or alternatively make a decision to go to foreclosure is a very complex set of determinations. So I don't know that I could give you a rule that would apply across the board on that.
Yeah. And what is your foreclosure percent to the total?
You got me off on.
Well, that's all. I think I heard 2%.
Let us provide that information in writing. We'll
provide
be happy
that
to provide
back
it.
to us.
We have the information about the loans since the meltdown. We have it overall for the whole history. We have it prior to the meltdown. I just, I'm not finding
That's
the right
fine. You can
page.
get that to me. And
Yeah.
another thing, too, when you, of course, equity is important to everybody. We want everybody to have equity. And, of course, the bigger the down payment, the more equity they're going to have going in. There are some people, though, I guess, that can't afford a home. And do you advise these people as such when they that possibly now is not the time for them to buy a house, maybe buy a home, maybe they need to go another direction, start with renting or something so they can?
When I was practicing law and when I was a member of Congress, I used to give that kind of advice, but I don't have the opportunity to give that kind of advice, nor is it my role to give that kind of advice. Fannie and Freddie don't make loans. We buy loans off of lenders' books and guarantee them and put them into a secondary market. So there's just not an opportunity for me to be engaged in those kinds of discussions with borrowers now. But, I mean, there are thousands of people. When I was practicing law, I would say if you can't afford to make a mortgage payment, you shouldn't be a homeowner. Yes, home ownership is not for everybody.
Well, I appreciate you being here. I hope that one day we can get the government out of the homeowner business and get it back in the private sector where it belongs. Mr. Chairman, I yield back.
The time of the gentleman has expired. Chair now recognizes the gentleman from Maine, Mr. Poliquin.
Thank you, Mr. Chair. Thank you very much for being here, Director Watt. I understand from your background you spent a little bit of time in New England, and I want to thank you very much in advance for rooting for the Patriots. Not that we'll need it, but on Sunday I appreciate that very much. Thank you very much.
I'm sorry I can't make that commitment to you.
I was hoping we'd start off on a good foot, Mr. Watt, but that's okay. Everybody that has been listening today, sir, understands that Fannie and Freddie are in conservatorship. And we, of course, understand that your organization is the, in fact, conservator. Now, I've also heard you say a couple times today, actually several times, that one of the roles that you're playing in this role, if I'm not mistaken, is to be sure, to the best of your ability, that Fannie and Freddie are safely and soundly managed, such that we keep the credit flowing to those who want to buy a home or are able to buy a home, and also to protect our hardworking taxpayers. Now, I'm going to be very honest with you, Mr. Watt. I have a little bit of a concern. If you look at Fannie, this is an organization that is connected to our federal government, that's been created by our federal government, that is responsible for $3.3 trillion of home mortgages, and they use our hardworking taxpayers to backstop those mortgages. I'm also concerned that Freddie Mac is also putting the U.S. taxpayers on the hook for an additional $2.2 trillion. Now, my other point I'd like to make, that is, if I'm not mistaken, in 2014, Fannie and Freddie together were responsible for holding 51% of all home mortgages in America. And that being the case, sir, would you agree with me that Fannie and Freddie are large financial institutions?
Absolutely, they are large financial institutions.
Good. Dodd-Frank, as I'm sure you know, Mr. Director, requires non-government large financial institutions to hold substantial amounts of capital in reserve in the event that something goes wrong. Now, I am not here advocating that those capital requirements for non-government entities be increased. However, don't you think it's appropriate, sir, that Fannie and Freddie, especially organizations of this size that are backstopped by the taxpayers, also ought to live by the same rules as that our non-government financial institutions when it comes to capital requirements?
I don't know that that's my decision to make, whether I agreed with it or not.
Well, you're the director.
You know, when I testified in the Senate, I said to one in response to a question, I don't have any personal opinions anymore. Well, every opinion I express now is an FHFA opinion, so I try not to express those personal opinions.
Well, I appreciate that very much, Mr. Watt, but with all due respect, you're in a position of a great authority. You're the regulator for the GSEs, and I would like to beg to differ with you a little bit, that your opinion is greatly appreciated. And what I'm trying to get across, if I may, is that we have two very large institutions that do not abide by the same capital requirements as other non-government institutions around this country. I might also add, if I may, that if you're looking at Fannie Mae with $3.3 trillion in assets, and this has been said here before, they have roughly $10 billion in assets, but they're asking the taxpayers to backstop $3.3 trillion in loans. Now, if you're looking at Freddie Mac, you're looking at Freddie Mac, they have about $13 billion in assets, and they're backstopping $2.2 trillion. So I think we could both agree, I hope so, that these organizations are grossly undercapitalized and represent one heck of a risk to the taxpayers if something goes wrong. Would you agree with that, sir?
I have two responses to it, one of which I've already given, which is I didn't set up the preferred stock purchase agreement. I wasn't even there when it was created, so I'm living under that. I can't change it without. But the second response is you all can change that. Everything that you just talked about, you can change by doing GSE reform.
Mr. Watt, everybody wants a healthy economy. And the taxpayers in our district in Maine, who are some of the hardest working, most honest people you could ever meet, they want to make sure they have a government that works for them and not against them. And I happen to believe that accountability in all stages of government, all levels of government, are a good thing. And I'm very concerned about these large institutions that are highly leveraged with very little capital that's requiring the taxpayers to backstop them. When we have interest rates at historic lows with a rise in interest rates that could cause a problem with the housing market and also our economy, wouldn't you agree that it makes sense to take a look at these institutions?
Time of the gentleman has expired. A brief answer, please.
I think I've already answered your question to the best of my ability to do it, Representative.
Thank you very much, sir.
That was brief. Chair now recognizes the gentlelady from Utah, Ms. Love.
There we go. I appreciate the opportunity to meet you here today.
Nice meeting you.
I just wanted to say, as a former mayor, I've had to ask myself 3 questions before making any new commitments or changes or going to a certain direction. And that is it affordable, is it sustainable, and is it my job? One of the questions I have, in your studies, did you determine how many people the lowering of the standard was going to help?
You're talking about the 97% product now? Is that the...
I'm talking about getting the standards to the 3% payment. Did you determine how many people this was going to help get into homes, how many people it was going to hurt? Did you have any
We have some projections that it would be a very small percentage of the overall portfolio of either Fannie or Freddie, and I probably have those percentages, but not the actual numbers.
Okay, so a small percentage this was going to help, bringing down these fees was actually going to help get into homes. So obviously we talked about some risk and risking the taxpayer dollars. I mean, but you have no guarantee. Is it fair to say that you have no guarantee that the people that are going to get in and borrow will be able to get into homes that they can afford and not default on their loans?
I don't think we're ever in a position to guarantee. We make responsible decisions based on risk assessments, and I can guarantee you that we have made a robust risk assessment. I don't think you could guarantee that anybody could pay a loan if they paid 99% down, because something might come up next week that would prevent them from doing that. So this is not about being able to guarantee it.
Okay.
It's about assessing the risk and likelihood of it, and we've done what we can to minimize.
So when I ask those questions, the reason why I ask those questions is because when we get into risk involvement and asking myself, is it affordable, is it sustainable, is it my job, we realize inevitably we've actually taken a lot of the risk out of those decision making. I believe that Utah believes, and the majority of hardworking American believes, that if Washington bureaucrats actually asked those same questions, we wouldn't be in the financial crisis that we are in today. As I've witnessed as a mayor, I have actually seen how these heavily involved government policies have actually hurt many cities in their abilities to thrive and to grow. We have watched homes being built and actually seen those homes a year later completely empty, and hardworking families lose their credit and their ability to get into a home. And so that's why I asked those questions about how does this actually help hardworking Americans get into a home and be able to sustain a future. Too many times I'm afraid that these government-backed programs that vowed to help and protect hardworking, poor Americans, it's actually done the opposite and hurt those that it's vowed to protect. If the administration, or that, as you would say, independent regulatory agency, go down this road of bigger government policies and getting involved more in what the free market should be involved in, I just want it on record that as hardworking Americans start losing their homes, that you remember this warning today. I've been in the trenches of this. I've actually seen this happen. I'm not taking a 60-foot view of what's happened. I've actually been a mayor, and I've actually seen my city have a really hard time with the housing market, and I don't want to go back into that direction. This is an area where I've said this is not about the hardworking Americans trusting you to do the right thing. It's about you trusting hardworking Americans to make decisions and do the right things for their future. I yield back my time.
Well, if you're about to yield, would you yield to the gentleman from Wisconsin?
Yes, I will yield my to Chairman Duffy.
Appreciate the gentlelady for yielding. Mr. Watt, going back to my previous question, the G fee, which we're talking about, was it risk-based? Basically, is to make sure that the GSEs aren't losing any money, right? You're trying to find that balance to go, boom, what's the cost? It's pretty. I'm not trying to trick you. This is a pretty simple and straightforward question.
It's a straightforward question, but it's inconsistent with the approach that a number of people have used, that we should be using G fees to attract private capital, because if we raise G fees to that level, we would be making a bunch more money. But is that an appropriate thing to do?
My question for you, Mr. Watt.
An appropriate purpose for G fees?
Mr. Watt, I'm not asking anybody else. I'm asking about you. You're trying to get the G fee to hit just right. We're able to cover your costs. You're not trying to bring in any extra money. You're not trying to lose any money. You're trying to hit the nail right on the head, hit the G fees right on. Or are you trying to make money? Are you trying to lose money when you set the G fee?
Well, we certainly don't want to lose money. That I can assure you.
Are you trying to make money?
So, but I think it would be more appropriate to wait until we come out with what we are going to do on G fees, articulate the reasons that we are doing it.
So, but this is this is an important.
And then you'll see where we come out. Because
but Mr. Watt, this is an
right
important.
now I don't have an opinion about the things you're asking.
You don't know if the G fee is, if you're trying to set it a little bit higher than the actual cost, or you're trying to hit it right on. You can't tell us today in this hearing how you're trying to assess
Representative
the
Duffy, if I knew that, we would have. I wouldn't be studying the issue. I mean, that's the reason we're going through this extensive study.
So what is the goal?
To keep from applying my own opinion about that.
Let's say, what is the goal?
Our agency is research-based. And we're going to apply the research that we have to that question.
Not trying to trick you. Is the goal, though, so let's take reality aside for a second, is the goal to get the G fee just right? Whether you can or not, in theory you want to get it just right where you're not really making any money and you're not losing any money. You're charging for the services consistent with the risk and other factors that you referenced.
One of the purposes is certainly not to lose money. We're not trying to set a G fee that's going to lose money. Now, are there other factors in addition to covering the risk and breaking even that should go into setting the G fee? That's a question that we are evaluating in the agency at this point.
But the intent is to look at all those things and try to hit it just right, correct? Not make any money, not lose any money, but take all those factors and get the number just right. It's a pretty simple question. I mean, I'd imagine the answer is yes. That's of course what we're trying to do here. We're trying to get it just right.
The gentleman's going to need to wrap up this line of questioning.
So very quickly, if you take a sweep for the Affordable Housing Trust Fund of 4.2%, right? You're going to sweep that money. It's not a tax, you're saying, But if you hit the G fee just right, but then you sweep 4.2 basis points away to go into the Affordable Housing Trust Fund, you're actually now below the cost of your risk. And so the taxpayers are going to bear that cost. Or if you go above the actual cost of the G fee, you're actually charging then the end homeowner an extra fee to drive money into the Affordable Housing Trust Fund. Either it's taxpayers that are going to pay, or it's those who have a mortgage who are going to pay. But someone is going to pay to come here and say that it's magical fairy dust and no one pays this money isn't really being totally forthright. Taxpayers are on the hook, or mortgagees are on the hook. I would ask if Mr. Watt agrees with that.
Mr. Hedges.
I've tried to answer this question as forthrightly as I can. With the size of our portfolio, I don't think we could ever set G fees to just break even. That could never happen. So if the question is, are you setting it just to break even? The answer is no. We have to have some margin, even if we don't take anything into account other than risk.
Mr. Watt, and you're a very good lawyer, and I can recognize that in someone. I appreciate it, but you're not answering my question. You know what it is I yield to.
I don't understand the question.
We'll allow the two very good lawyers to perhaps have this conversation online. The chair now recognizes the gentleman from Washington, Mr. Eck.
Thank you, Mr. Chair. Director Watt, let me add my voice of congratulations to all those that have been expressed here today. Much, much deserved. You'd indicated in your written testimony, and it's been alluded to, that on the 22nd of December, you approved a merger between the Federal Home Loan Banks of Seattle and Des Moines. Mr. Lucas, by the way, I believe that's the first, is it not?
It is, yes.
I'm going to confidently predict it won't be the last. Mr. Lucas also referred to the concerns among many of us in Congress about the new membership rules, which I don't want to relitigate this, but I want to state for the record, and you and I had a semi-private disagreement about this. I think both FHFA and Congress is missing an opportunity here to take a step back and re-examine just exactly what the role of the Federal Home Loan Bank should be going forward.
But be clear, that's exactly what we're doing in this evaluation process. We got 1,300 comments. We're going through every single one of them before we make a final determination of what the final rule is. So we're in that taking a step back, looking at all of the input that we have received. Just because we put out a proposed rule is not a final rule, right? So we're doing exactly what you suggested.
It's not the specific rule that I am focused on. It is the larger issue of what role do we want the Federal Home Loan Banks to play in this new world that doesn't look like it did when they were created in 1932 or thereabouts.
But Congress has made that determination. That's not a determination that I'm...
Which is exactly what you said to me earlier during our semi-private disagreement. I think it is something that you could do to advance to us policy proposals. I also think that it is an issue that members of this committee could well take up and ask the basic questions. What role do we want them to play? Is it strictly housing? Is it liquidity? Are there other ways that they can be constituted given the way that the whole world... But it's not really my question. I do have a question. My question does relate to the approved merger, again, which I don't believe will be the last. I had communicated to you in correspondence deep concerns held by people in the region about the continuing commitment of any merged regional bank to invest in housing. Also communicated to you concerns about governance. Also communicated to you concerns about operational issues, because after all, Director Watt, this is a 5-time zone Federal Home Loan Bank region now. And we've repeatedly asked for the letter setting forth the terms and conditions. We've been repeatedly told we cannot have it. We cannot know what those are. I want you to know that as that relates to sensitive financial matters, I completely understand. But I do not know what the compelling public good, what compelling public policy good is served by withholding information about how we will proceed with respect to the concerns that have been brought to you by many in the region?
During the pendency of a merger, for us to be putting out information that is still in the process of being discussed and negotiated, I think as an independent regulator would be irresponsible. I'm sure every one of these things will be addressed, but I mean, we have a fiduciary responsibility. We have a trust responsibility as regulator here, not to put out information that could jeopardize the discussions, and I hope you understand that.
Well, I acknowledge and embrace your fiduciary responsibility. Issues relating to housing investment and governance and operational issues that allow for access, I don't personally believe fall within that realm.
I can't assure you that the merged Federal Home Loan Bank will be held to the same high standards on those issues that we have held the two independent banks to, right? So we're not going to relax the standard just because the standards that we expect of them just because they're a merged bank.
Knowing as you
can be assured of that.
Knowing you as I do, I would expect no less, sir, and I thank you. One last quick question. Insofar as both Freddie Mac and Fannie Mae are under conservatorship, insofar as you are moving pretty quickly toward a common securitization platform, can you identify any compelling public benefit for these two entities other than it is status quo to be separate as opposed to one?
Well, you know, that's a public debate that I think should be had. There's a value to competition because it makes both enterprises better. We have aligned Fannie and Freddie's practices on a number of issues that were important to the public policy objectives. But I think there's some value to allowing them to compete on things that don't have a public policy imperative to them. So I guess, but we have aligned them on a number of issues.
I would take it that quality of service would be an example of that.
Well, if you talk to one of them as opposed to the other, they will tell you that their quality of service is higher than the other one, depending on which one you talk to. But it's important for them to continue to compete on the quality of the service that they delivered. That's one of the things that it is important for them to compete on.
It seems
we don't
arguable
want them
to me
competing on a race to the bottom to extend more and more irresponsible credit. You know, there are a whole range of things that we don't want them competing on, and there are some things that we continue to allow them to compete on.
So it seems arguable to me whether or not that benefit trumps the economies of scale, given that for all practical purposes we own them both. With that, I yield back the time I do not have and thank the Chair for his indulgence.
The Chair now recognizes the gentleman from Arkansas, Mr. Hill.
Thank you, Mr. Chairman. Director Watt, once again, it's nice to see you. Thank you for appearing for the committee for an extended period of time. I think back to one of my favorite engravings in the city of Washington, which is on the National Archives building, which is "What's Past is Prologue." And so I'm having a terrible flashback from a very, very bad movie listening to this discussion today. In 1984, when I was a staffer over on the Senate Banking Committee staff, Fannie and Freddie had about 1 in 400 loans that had a LTV of 3%. Then when I came back to government in 1990 and was at the Treasury, that had moved to 1 in 10. And then at the height of the crisis, it had moved to 1 in 2.5, or 40% of the loans in their combined portfolios were at that low down payment. And at the same time, that same direction took place in the debt-to-income ratios as well. So I just want to be on record with you that I share the concerns of many on this committee about this decision to lower down payment rates, notwithstanding counseling and FICO scores and private mortgage insurance. My question to you, I want to turn back to a line of questioning that Mr. Duffy had. And on this subject of the preferred stock arrangement with Treasury, for you to accrue money for the Housing Trust Fund, pay it out potentially in the Housing Trust Fund, did you seek a waiver from the preferred stock arrangement with Treasury to do that?
No, I did not.
And so it's purely on your judgment that from reading the statute that you've taken that money out of the system and not swept it to Treasury?
Well, there's no money to sweep unless there's a profit at the
Right.
end of the year, and there won't be any swept if there's not a profit.
Right, but you've taken the decision to sweep money if there is a profit.
Well,
I mean, you're to the Housing Trust
mean
Fund.
put it into
Right.
the house? Yes,
Right.
yes. Unless doing that would put them into a deficit situation.
Right. But did you seek approval from Treasury to do that?
No.
And don't you think that since they are the owner of that preferred stock on behalf of all the taxpayers, you should have checked with them first before taking money into the Housing Trust Fund as opposed to sweeping all the profits to the Treasury?
No.
And tell me again, I know you've covered some of this ground before, tell me again why you believe that's the case.
Why I shouldn't?
Why you believe you don't have to
Why I
seek
shouldn't get Treasury's approval?
Correct.
Because there's nothing in the preferred stock purchase agreement under which we operate that addresses the Housing Trust Fund. And so we're not violating the terms of the preferred stock purchase agreement in doing this. We're just simply complying with the law. And that's, so there's no reason for me to get Treasury's approval for that.
It just seems like when we own the shares of that company as the taxpayers, that we should want to have all the proceeds until there's a change, a structural change, made all the earnings of the company outside the core business operations. Any profit that's left should be sent to the Treasury.
That is still the rule. But you've taken I keep reminding you, I wasn't there when these preferred stock purchase agreements were negotiated. If they had put it into the agreement, then I would be obligated by it. But there's no provision in the agreement that requires me to get approval to fund the Housing Trust Fund or to comply with any other law that is in existence. So I didn't get their approval.
But you were there and took the decision to take money away from the sweep and put it in the Housing Trust Fund. That was your decision to do that?
I made the decision to reverse the temporary termination of contributions to the Housing Trust Fund. Yes, I was there for that.
Thank you very much. I yield back.
Gentleman yields back. No other member is in the room to be recognized. So again, I wish to thank Director Watt for coming to testify before us, our former colleague and former and still current friend of this committee. Without objection, all members will have 5 legislative days within which to submit questions in writing to the chair, which will be submitted to the witness for written responses. All members will have 5 legislative days within which to submit extraneous material for inclusion in the record. This hearing stands adjourned.